I will introduce our first speaker, and I'm hoping he's about to be added into the team. My head of IT was just in here, so he's going to add him in now. So I will speak fairly slowly just to ensure that he can be added. He has been added. So we have Mike Cook from MFS, our sponsors for today. You should have received, and there's Mike. Mike, can you hear us?
I can. Can you hear me okay?
Hear you fine. You're very echoey. You look like you're in a castle?
Well, I'm in our boardroom. It's quite big. Okay. But it's, I'll tell you what, I'll turn the volume down on the TV because the microphone is over here. Is that better, or is that still echoey?
That's absolutely fine. I think everyone can hear you. So you should have received this today. If you've not received an email from me this morning with attachments, just check your spam folder. If you've not got it, put it in the type your message, and my team will send it out. Because when I sent out 6 attachments, and it totaled about 10 megabytes, so it was quite a chunky email. So just let us know, and we'll send it to you in bits. So a little bit about Mike first of all. This is Mike's first presentation that he's done with Specialist Mortgage Web Show, so looking forward to it. Mike joined Market Financial Solutions during 2021, having previously helped provide billions in mortgage lending through customer-centric propositions. After starting in blue-chip companies, Aviva Investors and Arthur Andersen, Mike briefly joined Lehman's in 2007 as Vice President of Mortgage Products before moving to ING Direct in 2008, where he tripled annual mortgage lending ahead of joining the Bank of Ireland. Mike then moved to Vida Home Loans, where he worked until the end of 2020, having originated a book of 2 billion. From here, Mike joined MFS, and with over 25 years experience in the industry, has helped to bring their new buy-to-let product to the market. Mike's interesting fact, I've done this as well, is not with Harley Davidson. So for his 40th birthday, along with 3 friends, Mike hired Harley Davidsons in Las Vegas and spent the week riding via LA and the coast roads up to the Golden Gate Bridge. I did the opposite, Mike. I actually hired an open-top Mustang and took my youngest son, who was 16 at the time, from San Francisco down to LA. So we was actually on the coast side as well. If you've not done it, delegates, it's one of the best experiences of my life. So and if you ever get the chance, seriously, do it. It is absolutely brilliant. Anyway, Mike, over to you. I'm going to go and have a lie down and a stiff drink, and I will see you in about 20 minutes.
Tony. Right, so hopefully you can hear me okay, and thanks for inviting me along. Apologies if it's echoey. This is the only room I could get available that had some privacy in our office. We are office-based, so it gets pretty busy. So yeah, that's kind of a good intro, but sadly my motorbike trip was nearly 10 years ago, so it's quite a long time ago. So I've got to think up the new one for next year. So basically what I'm going to cover is a little bit of intro to MFS, because many of you probably never come across us before. We're historically a bridging lender. We've been bridging for 15 years. And we moved into buy-to-let, as Tony just said, a year ago after I joined. It makes sense because we have lots of different specialist funding lines that can do anything from really quick bridges through to sort of 30-40 million quid shopping centres and huge developments. So for us, there is a gap in the market, and where that gap is, I like to think of it as proper specialists, because you've got your high street, you've got your BM Solutions and their offshoots of Mortgage Works, things like that, which are happy for your mass consumer and clean, easy to do buy-to-let, and they go straight through without any concerns. Then you've got the specialist market, of which I've spent many years in. You've got your Precises, your Kents, your Fleets, your Peppers, your Vidas, all those kind of guys, and they're all actually funded in a very similar way. So all their criteria is actually very, very similar. It's very hard to differentiate. And what you tend to get is one might do a little bit of expat, one might do a little bit of adverse, one might allow up to a £4 million portfolio or a £6 million portfolio, but they're all actually fairly generic. And then you've got what I would call the proper specialist market, where it's bordering into commercial, it's bordering into easy, it's bordering into larger properties, more complex individuals, higher net worth individuals. And that's very much where MFS sit. And I'll explain a little bit about how we're different and the types of consumers or inquiries that you may get and actually you're wondering where to place them, and you can convert more of those inquiries actually into commission ultimately. So let's see if this works. We are down to here. So hopefully that's worked. So one of the things about being a property specialist, and what I like about being in a smaller firm, and I've worked for big banks and bigger institutions, growing institutions. I was in a room with 5 or 6 of us when we started Vida, and left when it was sort of 160 people. The nice thing about being small and having very flexible funding lines is you can have direct access to underwriters, and they'll stay with the case from start to finish. It's not handed to another team to take it through to deal with conveyances and hold things up. We have 4-hour response times from when you send documents in to when you get a decision back. We have round-the-clock processing. We have an office in Singapore, so when we go home, they pick it up, and they can be picking up overnight inquiries and things and allocating them to underwriters for the next day. We've got several institutions that back us, as well as several private, family private wealth offices as well that invest in bridging loans and things, but predominantly we are institutionally funded. But one of the key things around willingness to lend, the underwriters, we don't like to hire underwriters from more mainstream lenders because they're in this mindset of credit won't like it or it doesn't fit policy. We have a very broad policy. We try to make things fit. And speed, we can complete the same suite of bridging, but unfortunately we do have to use conveyancers that many other lenders use. So therefore we are a little bit at the mercy of conveyancers, but we generally find a way to meet the timescales of whatever people want to do. I won't dwell on this slide because you're all aware of what the market is doing at the moment and where it's been. Yes, average rates have hopefully peaked. It's been a very topsy-turvy time, but it looks like it's starting to settle a little bit. But the average rates still are north of 6%, and not that long ago they were hovering between 2 and 3%. Average prices have shot right up, as we know. They're still increasing, but the speed of increase is slowing slightly. There's been some regional variation, which is good in some places, but only as long as the affordability keeps up. And of course, the rents, they've been shooting up as well. And as people move back into cities after COVID, that creates demand, and then demand means landlords can start to recruit, but also the government intervention in things. Letting agents can't charge tenants fees, so they charge the landlord. So what does the landlord do? They have to put the rent up. So there is this period of adjustment that will probably go on for another couple of years. Okay, let's just go on to a little bit about what I would mean by proper specialist and for us ourselves. So you do have the same dedicated BDM and underwriter, and we only use a fixed ICR of 120%, regardless of whether you're an onshore, offshore company, high rate taxpayer, whatever else, because high rate taxpayers tend to be fairly savvy. People that invest in buy-to-let, particularly in specialist buy-to-let, tend to be savvy. They tend to be comfortable with money. They tend to be fairly asset rich. And what's the point of punitively controlling what they can borrow for a high tax rate that may just impact what they take home from their standard pay? We also bring in some of the elements of what's traditionally been a bridging element, which is we allow different tools to let us lend more than many peer lenders. So, for example, we can roll up and capitalise up to 9 months of interest. So if, for example, you've bought a place with no tenants, well, don't pay anything for the first 2 or 3 months. Just add that interest onto your loan and pay us in month 4. If you want to make ICR fit, well, defer some of the interest. So, for example, go from 8% down to 6%. We'll use 6% because that's what you'll be paying for the initial couple of years. And it allows us, and that interest that you should have paid us, again, just put onto the loan, pay us when you redeem. And so all of these tools allow us to look at things very differently. We're not a bank, we're not PRA regulated. We have our own views, and we take a wider view on assets and liabilities of a customer and their situation. And we make a call based on that and try and make it fit, or a loan size that will fit their circumstances. We also allow top slicing, which, okay, that's fairly standard in some specialist lenders, but when you combine it with the other tools, you can get a fairly powerful loan size. Adverse credit, we don't turn our nose up. It's not a big part of our book, but you know, we do have people that have had liquidations or previous bankruptcies and things like that. We can do bespoke pricing to put a deal together for that particular situation. We've recently increased our terms to 15 years. We went to market quickly. We're using our bridging funding lines. We've now expanded with buy-to-let funding lines specifically. And the great thing about that is, you know, we allow a 2-year fix or tracker term. We launched trackers a couple of days ago. And then you move on to a tracker revert rate linked to the Bank of England base rate. So it gives you optionality. You know, we don't have an overhanging ERC. You can leave after 2 years. You leave within 2 years with a small ERC. And there's no overhang, and you can stay with us. You can refinance away. You can sell the asset. Doesn't really matter. We don't require a UK credit footprint either, whether that's an expat or a foreign national. Or a company registered offshore, that's fine. That's in our expertise. That's what our underwriters are trained to do, and they take a view on all these situations. And we underwrite from day one. So what we tend to do is we will get your all of the things that we need, and we will go to credit committee to get credit back terms. And when we issue a DIP, that is essentially, as long as you can back up everything that you've said, a yes is a yes, and we will work on that basis all the way through. Okay, let me just find the arrow. There we are. Okay, so some of the things that I've talked about, but yeah, we are happy with large portfolios. We've done a couple of 20 million portfolios. We split them across different funding lines. So, you know, we don't background stress the portfolio. We just want to make sure it washes its face and people aren't over leveraged. We do large loans. We don't do that annoying thing. Oh, I want £1 million. Well, you can only have that at 60% LTV. That's fine. You can have up to £3 million on a property. We'll do it up to 75% LTV. We do 25, 30 million quid bridging loans. We're comfortable with large loans. You can have many properties on one loan. That's fine. Some people don't want various different legal agreements and direct debits and everything else. That's fine. You know, we've had one case with 13 properties on one loan. Yeah, it's one legal agreement. It's just a lot easier, and we'll handle the complexity. And again, that's a very specialist thing. We don't really look at outside employment and income. We tend to look at assets. We tend to look at the position of the rent and the security property. First-time landlords, that's fine. Limited company SPVs, trusts, they're hard to place, but they're increasingly a good part of inheritance tax planning. We do offshore trust, onshore trust, partnerships, you name it. Again, we just look at the structure and ultimately who is the ultimate beneficial owner of that trust or that company. And that's the sort of thing that differentiates, and that's why you need good manual underwriting. And we've talked about adverse credit. So offshore, you know, some people, we do a fair amount of foreign nationals. Some of them live in the UK, some of them don't. Some only have, that's their first foray into the UK. That's fine. You know, we have tools that we look at their situation in their home country. We ask for a managing agent in this country, someone that we can contact with if there's a direct debit that's missed or late or whatever else. And we just work in a common sense way. So companies, trusts, expats, foreign nationals, whether or they've not got a UK footprint, that's fine. And sometimes, you know, we even do politically exposed people as long as they haven't got diplomatic immunity. Again, it's about understanding the individual and making a decision based on that. We don't do, you know, sanctioned countries, but we do have individuals that may be, for example, an Iraqi national, but they've been living in the UK or they're living in America, wherever it may be. The country they're from may be sanctioned, but where they're living and where they're buying the property here may well not be. Property, lower yields and prime locations. A lot of what we do is London, or it tends to be the bigger cities, where the yields, you know, maybe a capital appreciation play. So, for example, with many lenders, you know, you can't borrow anything anywhere near what you need to be able to. With us, you can use rolling, you can use deferring. We can even take comfort charges on other assets if the case is particularly tight. That's the sort of stuff you can't do with a fleet, with a land bay, with all those kind of guys. We'll do new build flats. We'll look at HMOs any size, no limit. Student lets, flats above Snellies, the less desirable commercial, up to 70% LTV. Very large multi-unit blocks. Holiday, short-term lets. We have a fairly broad policy on those. We tend to look at an average of high, medium, low season rents and 30 weeks occupancy unless you can evidence otherwise. And we do make exceptions on holiday parks, and we've done some on a little island in the Lake District, very luxury properties. So again, we just tend to make a call based on the type of assets. Okay. This is just an example of affordability because it's actually quite hard to understand. Sometimes you have to let the underwriter go with the flow. What this one tends to do is we will allow, our online calculator does it for you, and it can email you the results and things like that. But we will assume, a situation where there's no rolled and deferred interest. That's a vanilla ICR calculation. And then we'll show you what happens when you roll up and capitalise 6 months of interest and 1.5%, 1.5% of interest and 6 months payments onto the loan. And this is an example where if we take a generic specialist, I did this one at the end of last week, and a 744 5-year fix. They used to do a 2-year fix, but they don't at the moment. And that was even a stressed rate. We don't stress our rate. Now, in this particular example, on a high rate taxpayer, £1.3 million property, the max loan that will come out of their calculator is 395k, which is only 30% LTV, which is not really a lot. And that is in part because rates are much higher at the moment. And again, you're being penalised with stress rates on already high rate. Product fee is 2%, which would work out at £8,000 on that, and the prop fee would be 0.5%. So when you put that through MFS calculator, and this one's using a little bit of underwriter discretion, a little bit of extra rolled and deferred. So an 8.79 rate would be deferred, would be calculated at 6.79, and that's the direct debit you would pay in the first couple of years. We would stress at 120%. So the net loan we would come out with, which is what you pay on day one, is 733 grand. That is nearly double what you get from this generic specialist based in the southeast. Gross loan, which is what you pay back with all deferred interest and everything else, is 825k. So that is 55% LTV on what we pay down day one. In today's market, it's very difficult to get to 75% unless you've got a very, very generous tenant that pays you lots of lovely rent. But that's one of the challenges for brokers today, which is why looking around and making sure you can borrow what the customer needs is a good thing. We pay 1% prop fee. So in this particular example, that will be £8,000 as opposed to £2,000 with a much smaller loan. So that's just an example of how that works. But our online calculator explains more of that. And of course, the BDMs and our underwriters will walk that through you and which option is best for you. Okay. This one is just an example of our fixed rate guide. Our tracker rates are available now as well, and they start from 7%. Fixed, I'd like to think at a bit of a peak at the moment. You've seen some of the rates start to come down. I'm sure that will be once the minutes come out from the Bank of England base rate, the Bank of England monetary policy meeting today. Once those minutes come out, banks can digest them. I'm sure the future projections will start to come down a little bit, and that should bring down the costs of fixed rates in the near term. We tend to have a very simple cascade. You're probably used to a cascade environment where we assume everybody starts on the left, unless there's something about the property or the individual that may increase the risk and therefore the rate. Okay, these are just some examples of some case studies. I won't dwell too much on those, but we do a whole variety of circumstances, and often some lenders specialise in a particular borrower complexity, some about a sort of property complexity. We're happy with all kinds of complexity, and that's why we have a team of 15 underwriters. We are based in London. We have BDMs based around the country, and we have a dedicated buy-to-let section. We work together when we need to do a kind of bridge to let. So we will have either developer exit where they've built a load of flats and they want to keep a couple as investments, but they want to release funds to the next project, so they will do bridge and the buy-to-let. We do allow light renovation on our buy-to-let product, so nothing that needs planning. And a great example would be, don't pay anything for 2 months, increase the EPC, therefore get your windows changed, get your loft insulated, get the walls done, get the EPC rating up, and therefore your rent would go up, and then start your direct debit in month 3. So there's all sorts of weird and wonderful scenarios. We do, if it's a very quick purchase and you need to do heavy renovation, great, do a bridge. We'll give you discounts and things when you come over onto a buy-to-let product. We will get slicker at joining it all together, but we've been live mainly in the market since January this year. We've had over 1.7 billion of inquiries, so we've been doing really, really well. We've got a roadmap of things coming up, and we've got additional funding lines, we've got additional markets we want to go into. So the questions just popped up. Yes, we do commercial leases. We've done a large portfolio for a higher profile individual that has done exactly that, length lets and 5-year leases. We tend to get our solicitors just to review the leases and the conditions, and then we will make a call on that. Let to buy, that's just popped up. We can, as long as you're comfortable, because we don't do regulated lending. If you're comfortable and we are comfortable, then that's something we can consider, but we tend to work more on unregulated business. Studio flats under 30, we have made some exceptions, which are just below, but it depends if it's part of a larger multi-unit block or where some are small, some are larger. And stress test rate, we only stress on our trackers, and we just assume that BBR is going to be 4%. We don't stress on our fixed rates. Tony, conscious that you're keen to get back on time, so I've covered most of what I want to cover in a very quick way. I can hang around and look at the questions for a little bit, or you guys can mail me offline or send me them. I don't mind.
You've done my job for me, Mike. You actually, Doug, you answered the questions before I got a chance to ask them, so that's no problem. That's good. That's good. I just meant I could lie down for a little bit longer.
It's a big telly, so they're in my face.
Absolutely, I can, yeah, so I can see. Right, that was brilliant. Thank you very much indeed. I'm sure we've all learned something today, and interested to know who the generic lender is in Kent in brackets. I wonder who that might be. Who've actually just changed their rates today. I've seen there's been an announcement this morning, but I've not actually seen what they've changed to. So if it's
that date already.
Yeah, so there you go. They probably reissued 2-year fixed rates, so who knows? I will ask one question from the ones you set yourself, and then we'll move on to the next speaker. So one of the questions you set was, how have lending requirements changed along with the current levels of uncertainty in the market?
Well, I think one of the things that everybody's really picked up on is its affordability. I think certain lenders start to pull back on criteria when things get tough, and it's a knock-on impact. So, for example, capital markets, a lot of lenders securitize. They bundle up their loans, they will sell them as bonds, and they will get that money back, and they will start lending it again. Those markets dried up, and that really did impact some of the specialist lenders. So they start to then tighten up on the range of rates. They might only have one option available. They might have no options available. There are still 4 or 5 lenders with no products for sale at the moment, or they want a minimum loan of £1 million. And that is very much because the exit for those loans for them might be less obvious. And people tend to clam up on risk at times like we've had in the very brief trust era, but also Putin, Ukraine, all of those sort of things with the cost of living. And I think you were sort of saying, Tony, just as I sort of logged in, it really starts to impact brokers trying to find a place, A, for the criteria, and B, to get the loan size to allow them to do what they want to do, either buy what they want or get enough to exit the loan without a big shortfall to be able to refinance. And, capital raising might be off the table for many of them. So I think that has been the most obvious difference, and then probably forensically diving into affordability as well.
That's brilliant, Mike. Thank you very much indeed. Thank you for making up the time for our internet issues a little bit earlier on. Simon will remove you from the room. Don't remove yourself, because you can close down the whole show, because you have that ability. Don't touch that keyboard, Mike. Don't touch it. Simon will take your egg on. You don't want that to happen again. Very interesting. That's the first time we've ever had a presentation with somebody standing up. We did have one a few months ago, somebody that was upside down because they were doing it from an iPad and it wasn't configured properly. But that was the first one standing up, but lots of good stuff in there. So we'll move on to our next one, our next speaker, which is Matt Yates from Precise Mortgages. He's got his Precise Mortgages hat on today. Normally he's got his Interbay hat on. But today he's talking about bridging, and I'm hoping he's about to appear. Matt, can you hear us?
I can hear you. Can you hear me?
Fabulous, absolutely right. We will crack on. We're a couple of minutes behind, but again, you should have received this, everybody, in the post. Sorry, by email this morning. If you haven't got it, just again we are trying to find out why some of you haven't got the stuff this morning. Probably because of the size of the email. It's probably been knocked back by your internet service provider because it was over 10 megabytes. So they can be sent out to you in chunks, I believe. So that's the next step. A little bit on Matt, first of all. He's been working in the mortgage industry since 2005, starting with just one account. He helped start up RBSIP, which later became NatWest Intermediary Solutions. Matt progressed to a field sales position with Platform, then moved to Precise Mortgages. Matt took the opportunity to take a sidestep to Interbay Commercial in October last year and is currently working as Specialist Finance Account Manager whilst continuing to help brokers with Precise Bridging Finance, and that's what Matt's going to be talking about today. Hopefully that's right, Matt, because when I saw this yesterday, it was... I was trying to work out if that was actually the correct wording, but I'm hoping it is.
Yeah, pretty much. I'm happy with that.
And this is Matt's interesting fact. Matt used to break dance in the 1980s and danced on a London stage, BBC TV, as well as a number of seasons at Pontins.
Oh, yeah.
Wow. Okay. There you go. I'm there.
Don't ask me to do any break dancing.
I'm absolutely not going to.
Okay, cool.
All the times I took my kids to Pontins in the 90s when I was skin, I never saw break dancing. But,
yeah, we were bespoke.
Absolutely. Right, over to you. See you in about 2 minutes.
Thank you very much. Thank you very much, Tony, and good morning, everyone. From a very rainy Norfolk here. I hope the weather's the best where you are. So it's a good introduction, really, because I do work within Interbay, but my role, let me just move myself down a little bit. My role just still stems through to Precise Mortgages, in particular the bridging side of things. So I've got my bridging hat on today. I've got my Precise hat on today. And it's going to be a mixture of two things. I really want to give you an idea of the kind of conversations I'm having with Tony and the team and my other brokers, and also what brokers are telling me about the market. And obviously, I want to give you an introduction of how Precise can help you or help your clients with some tricky situations, because let's be honest, not everyone wants bridging finance. It's there for a reason. So we'll work through them anyway. So bear with me. So let's start off with reasons why bridging finance could be needed by your clients. There's a few reasons in here. Some of them are obvious. Some of them might not be so obvious. So number one, they need a short-term borrowing solution. Now, don't be hung up on the word bridging finance. Bridging finance is short-term finance. Some people think the word bridging is a dark, mystical art and it's overabused, it's too expensive, all of the latter. If your client has heard from John in the pub that bridging is not something he should be doing, use the word short-term finance. Short-term borrowing needs. So if someone's got a property or properties and they want to secure against for a short period of time for pretty much any legal reason, then a bridging loan, a short-term bridging loan could be an option. Okay. Now, number two, very, very common. They want to renovate a property. If they already own a property and they feel that it's time for some improvement for a couple of reasons. One, for EPC, which we'll come on to a little bit later on. But number one, because the tenants have gone, left it a mess, and they can see the opportunity of getting new kitchens, bathrooms, etc., and getting some decent tenants in. Decent tenants equals decent rental yield. So they want to renovate a property. Bridging finance could be the short-term answer there. Want to go to a property auction? This goes with number four really as well. They need the funds quickly. Do an awful lot of them. Doesn't seem to be as many what you'd call bargain properties out there as there were about 3 or 4 years ago. But I've had conversations this week of people going to auctions, so there must be. So yeah, we are a lender that can assist with short-term finance if your customer wants to go to auction. I'll skip 4 because it's really to do with needing to raise capital quickly, which goes with number 1 and number 3. It stands to reason. Bridging is quicker than a lot of long-term lending at the moment. But number 5 is interesting, and it's super, super popular, and that's not the right word to use. It's very common at the moment. Let me give you a scenario. Let's just say you completed a mortgage for your customer, or I say apply for a mortgage for your customer, and there's a chain and they're all ready to complete, and lo and behold, your customer's purchaser pulls out, and a bit of a flurry. Your customer calls you, so what am I going to do? I've got to buy that property. The estate agencies are already sort of hassling me to commit to it. What can I do? Now, the way I see it, in a scenario like this, there's three options. Number one could be they might have a very rich uncle that can help them out, and they could buy it for cash and then sort it out later on. And the chances of that is going to be slim, let's be honest. Number two, they could wait. They could wait for someone else to purchase their property. They might be lucky, they might not be. The market's a little bit up and down at the moment. Or number three, they could get bridging finance or short-term finance to purchase the property. And then when they sell their property, they'll pay the bridge back. Okay. Very common, and it's probably one of our number one biggest areas of bridging that we do. And it's something that you will have at the disposal of your customer. If they come to you with this really sticky situation, you can have a chat with Tony and the team and say, what can we do? So there we go. There's just some reasons why bridging finance could be suitable for your client. Now, let's go a little bit deeper. The three main areas of bridging are going to be a standard bridge. Basically, your property that you either own or you're going to buy is fine. Okay, doesn't need any amendments to it. You need short-term finance on it because you want to buy another property, you want to buy a speedboat, you want to pay off some of your residential mortgage. There's lots and lots of reasons. Thinking of reasons that we might not be too comfortable with, I can really only think of bailing out a failing business, or potentially paying off a very large tax bill. But everything else seems to be fair game. This might be a good option for them. Okay. Now, light refurbishment and heavy refurbishment, I probably talk about the most. And again, it could be where I'll go into light refurbishment in a little bit more detail in a minute, because it's probably the biggest area for us. The difference between light and heavy refurbishment is this. A light refurbishment is basically the property is not going to structurally change. It's just tired. So it needs a new bathroom, needs a new kitchen. The electricity is a bit iffy. Electrical points are a bit iffy. Needs a bit of an overhaul. Okay. A heavy refurbishment basically means some works need doing to it. And I'll reiterate this in the light refurbishment slide next, but the best way to think of a difference, generally speaking, for light refurbishment and heavy refurbishment is the blueprint of the property going to change? And another aspect is, am I going to need planning permission to do what I need to do? Because that will generally push it outside of light refurbishment. Not always, but generally. And obviously, the last line there is really what you can do to a property in these scenarios. You can change it from under light refurbishment, you can change it to a 6-bedroom HMO or convert a garage. Let's go into a little bit more detail on light refurbishment, because this crops up an awful lot. So, and just to reiterate what I've just said, the first little section there in the middle says no overall change to the use and nature of the property. It is a residential property. It will stay a residential property. There's going to be internal refurbishment to it. Now, generally speaking, a property that is in a pretty poor condition at the moment is going to be unmortgageable. So while there's two scenarios here of changing a property that a landlord has in their portfolio from a pretty tired property into a more desirable one, you could also buy a property that you're not going to get with a mortgage, because there's certain conditions mortgage lenders want. It has to be in good condition, ready to let out, etc. This is when light refurbishment bridging should be talked about. It's taking an unmortgageable property. It could have really low EPC, and again, we'll come on to that in a minute, or just a really, really bad, really bad state and need a lot of repairs to it. Taking it from bad into good. Now, I'll end this presentation with a particular product which really highlights the benefits of bridging and how you can take it from the really poor to the very good. What you can do with light refurbishment, and this is not going to happen too often, but it just kind of shows you, you're not really changing the blueprint here, but you're changing a garage into a living space. Now, that's really beneficial because what you're doing there is chucking another room in there. That could help with HMO. That could help with the rental yield. And at the moment, and I think that Mike just mentioned it in the previous slide, that an awful lot of lenders are struggling with rental stress testing. And you're not going to struggle with rental stress testing as much if you've got a lot of rent. So an HMO is obviously a very good consideration of a conversion of a property into an HMO because you get more rental yield. So there we go. That's a bit of an overview on light refurbishment. As I say, it's the biggest single area for us. And when you think about pricing, and I'm not going to go into pricing too much here, the pricing is the same for standard bridging and light refurbishment. It's a little bit more expensive on heavy refurbishment. Okay, and when I summarize at the end, I'll just talk about the loan to values, etc. We shall move on. Just going to finish off about how beneficial a light refurbishment can be. This is a massive, massive topic at the moment. This slide doesn't actually go into detail of what should happen in 2025. All let properties, all buy-to-let properties need to have an improved EPC. I believe it's going to be C. We haven't got sort of the confirmation of it all yet. Now, this could be a bit of a problem for landlords going forward. If they've got a portfolio of 20 properties, how are they looking at the moment? Are they all grade C? What can a landlord do? This is where you can jump in there, potentially with buy-to-let remortgaging, or if it's really unmortgageable at the moment and they really want to do some good improvements and lift the EPC to C, consider some bridging finance to improve it now in time for when this legislation comes in a few years' time, where all buy-to-let properties need to be a C. So it's something worth talking to your landlord about now, because 2025 will come along very quickly. And if your customer wants to remortgage one of those properties in 2025, 2026, and it's not to the required EPC level, guess what? It's not mortgageable. And this is when we go back to what options someone has in regards to making it mortgageable, and bridging short-term lending is going to be one of those areas there. Okay, so we'll move on. Now, exits. Now, I've talked a lot about bridging this week, actually, and I kind of summarised to the brokers I'm speaking to. An underwriter really focuses on two main things. Number one, should we be lending on this property? Yes, it might be a bit tired and need renovation, but is it a property that if we have to take possession, we could sell on? Now, let's take a really good example. A terrace house, a typical terrace house, is a fantastic property to take on. It's going to be let out so easily compared to a lot of properties. Generally speaking, they're structurally sound. So I always say, if I'm speaking to brokers and they're speaking to their landlords about how they should develop their portfolio and decent properties to start with, conversations always kind of revolve around terrace properties and how easy they are to rent compared to a lot of other properties. So number one, should we be lending on the property? Number two, and this is as important as the property, how is your landlord going to pay us back? There's generally only two exits, and you'll hear the word exit if you're not familiar with bridging, the exit. Number one, you remortgage a property. It could be the property that you have renovated and you look to do a buy-to-let mortgage with another lender, or it's sale of the property or another property. Now, going back to what Mike said earlier on, and this is what I've been reiterating a lot to my brokers, especially this week, actually, is it is now harder to remortgage buy-to-let because of the enhanced stress testing of the increase of buy-to-let rates. Now, I agree with Mike. I think this is probably a short-term thing, and the rates are probably going to come down a little bit. So we will do our due diligence when the case comes in to make sure that, are you going to be able to remortgage this? Is there enough rent there? So within Precise, for example, because we've got Precise mortgages, the buy-to-let side, sorry, the underwriter will do a quick check on the Precise buy-to-let calculator to make sure it stacks up. And the Precise buy-to-let calculator in the whole is pretty good, to be honest. If the underwriter has real concerns that the exit of refinance might not be achievable, then some more focus would need to be put onto that exit. So just a summary there, when we're talking about a bridge, the underwriter's real main focus is the property or properties and how are you going to pay us back. So when you look at bridging finance or think about it with your customer, don't just think about the bridge, think about the exit as well. If they want to sell the property, can it sell within that agreed time frame? Usually we'll do a bridge for 12 months. Is that enough time? Usually, let's go back to the scenario of a nice, easy terrace house. Yeah, probably it will do. So there we go. That's exits for you in one quick slide. Now, I'm going to finish off with a product that we've had for many years that I've been working with brokers on. It's called a refurbishment buy-to-let product. It incorporates a light refurbishment bridge and a buy-to-let remortgage all in the same application. I have to say at this point, frustratingly, this particular product is currently unavailable, but it will come back. The reason we took it out of our product offering within Precise was because the buy-to-let rates, the uncertainty of the buy-to-let rates, and when we get a bit of stability, it will come back. Okay, but we can talk about it now as a product that you know will come back in the very near future. You'll take a property from that to that, and you can do that with bridging finance and have the assurity, and this is the word, assurity of the exit. The exit is going to be the buy-to-let remortgage that is underwritten right at the start using the figures from the valuer. The valuer will go to the property, see it in the state it's in at the moment, go, yeah, it's probably worth £150,000. The valuer will know what the customer plans to do because you've provided a schedule of works. That will go to the valuer, and the valuer hopefully will agree, yeah, I can see with what the plans you're looking to do, that could be worth £225,000. If that all stacks up, then you've got that exit already done and dusted. The next slide should go into a little bit more detail here. One application form. So Tony and the team will collate the information from yourself, submit one application form to the underwriter. There is one underwriter for the bridge and the remortgage. Now, they will work closely with the underwriter just to make sure that, and they're very approachable as well. This is what I've found within the bridging underwriters in Precise, very approachable, very hands-on, very proactive. There's two offers that are produced. The offer is going to be the bridge, which can be up to 75% of the property's current value. The buy-to-let remortgage can be up to 80% of the revised after-works figure. Now, if you think about those two figures and known to values, the property could jump from there to there. The aim is to pay the bridge back with the buy-to-let remortgage. 2-3 years ago, when I was having lots and lots of conversations with brokers, and there seemed to be a lot more of these types of properties out there, I was hearing stories of the more savvier landlords that were buying them and capital raising up to 80%. Yes, they were paying the bridge back, but they're also getting their deposit money back and getting some extra money, and they were going on to the next project. And the net result is you're taking a pretty unmortgageable, unlettable property, and you're converting it into something that is future-proof. The EPC's gone up. You don't need to change the kitchen and bathroom. You've done the electrics and gas. That's going to command a decent tenant. A decent tenant is going to pay good rent. This is why this product, and bridging in general, has been so popular. It's been so popular because you need to put some skin in the game, but the end result is you've got a really good asset in your portfolio and you don't need to touch it for 10 years. Okay, so especially with the EPC that's going to kick in as well, this is what landlords need to be thinking about, the condition of the properties they have. I mentioned a schedule of works. I don't really like to talk too much in these presentations about the documentation, etc., more about the kind of how we can help, but a schedule of works is key. If you've got a landlord that is a customer that's looking to do a bridge or the buy-to-let refurb product, and it's a light refurbishment, and they write their schedule of works on the back of a fag packet and send it in, it's not going to give the confidence to the underwriter that they really know what they're doing. Okay, so a schedule of works needs to be detailed. It needs to show three things. It needs to show what they intend to do, how long it will take, and how much. And that's going to give confidence to the underwriter. They've thought about it. They've got a contingency plan, a little float of extra money there as well. It's a very important document. And I know Tony and the team will work with you on one of these and how you can present it in the right way to the customer. It's very, very key, these points. Okie dokie. I'm going to summarize. I'm just going to summarise on bridging. I'm going to summarise on what Precise can do. Precise Mortgages bridging are and have always been a good go-to lender for bridging. Good rates. And let's talk about rates very, very quickly, because I've never had this luxury of saying what I'm about to say. The throwbacks I get from brokers and landlords and customers is bridging is expensive. Now, let's just take what the rates are at the moment for a 50 to 55% loan to value bridge. For light refurbishment and standard bridging, it is 0.47 per month. Times that by 12 and you get what a normal buy-to-let rate. My math stats 5.7-ish, maybe 5.6. Is it expensive now? If you're doing it compared to a buy-to-let rate, I didn't have this luxury a couple of years back when the equivalent would have been sort of, buy-to-let rates weren't that high. We can't have the argument now it's too expensive. Yes, there's some fees and arrangement fee, but the interest rate compared to long-term loans is very favourable at the moment. So, let's just summarise in regards to what we can do. Regulated, non-regulated. Regulated, they're going to live in it. Non-regulated, it's going to be a let property. Up to 75% for light refurb and standard, 70% for heavy refurb. Lending across England, Wales and parts of Scotland. The Precise model is in certain postcodes there as well. Maximum of 12 months on regulated transactions. So we can step to 18 months for unregulated. But if it's going to be a chain break, for example, the term will be for 12 months, fully aware that the customer shouldn't take that long. And remember, the interest rate is calculated up to 12 months, but if they complete in 6 months, 6 months interest will only be paid. It's all relative, okay? You can do 4 people on an application as well. I spoke to a broker this morning, and there's going to be 3 that's going to be coming onto a mortgage. One of them's got a lot more experience than the other 2. So there's some good examples there, I hope, of bridging, generally speaking, and how Precise and how Tony and the guys can help you with my model. There's a lot more you can go into knee deep about it, but I think in 20 minutes, I hope you've got a bit of an overview of what I'm talking about at the moment and what your landlords can utilise Precise for. On that note, I shall pass back to Tony.
Matt, thank you very much indeed. Any questions from delegates? So we haven't got anything as yet, so we're going to go on to the ones that you set yourself.
Yeah, no
I've got one I might ask in a minute as well.
No problem.
So what changes have you seen to the types of inquiries over the last 12 months?
A drop in refurbishment, and I think it could be, Tony, not just the last 12 months, but probably the last 24 to 36 months. A bit of a drop in people going to auction. A bit of a drop, not a huge amount, but having the opportunity to find those bargain properties, they're out there, but it seems to be 3, 4, 5 years ago when I was talking about this, there was a lot more out there. So yeah, that's been the drop, and an unfortunate sign of the times. The increase has been the regulated chain break situation. It's a nightmare if you've got a large chain. And this happens a lot. And I personally believe it's something worth talking to your customer about, not your landlord, sorry, your customer about if they find themselves into a chain break situation, because there are options. Okay. So there we go. They're the changes, Tony.
Okay. Second question, what challenges have you faced with brokers and their respective customers on considering bridging finance?
Well, it used to be the cost. It used to be how much bridging is. Now, just to put that in perspective, there's a monthly interest rate and there is an arrangement fee. And when you send the customer, and we've got a very good calculator on our website actually that you can print off and show the rolled up interest, etc. If you send it to a customer, you can frighten the life out of them because it looks pretty full on in regards to the amount it costs, etc. They've got to think of the end goal. That used to be a real kind of contention point, but not so much now, because I think people are more used to the idea of short-term lending, and compared to long-term finance, I don't see that too much. I don't get that barrier as much as I used to.
Okay, but my thought was, I mean, for those of you that have received my email this morning with the precise details, you can see it's actually dated June 2022. There's been no changes whatsoever
Yeah.
in that time.
I think it's due
I
for a
keep going
change.
on the website just to make sure that their marketing department hasn't missed us out, and they're about to increase rates. But one of the things we did recently, because there were so many changes so quickly, this isn't available, by the way, to everybody. Something we use internally, which is this, which has every lender that we deal with on the bridging side and their rates at each LTV point. And Precise are by far and away the cheapest at the moment, all the way up. I mean, the only lenders, the occasions that you see a lender that might be cheaper is when they say rates from. And you know you're not going to get that rate when you put the deal to them. It's probably going to increase by like 50%. So at this moment in time, Precise for your customers, and at 0.47, like I said, you're getting a rate of 5.6, 5.7. That's cheaper than a specialist buy-to-let rate at the moment.
Certainly is.
So it's I need to bring out a 36 or I need to bring out a 5-year bridge. I think at the moment would be great if they could. Then we'd all be having it away. So, okay, Matt, thank you very, very much for that. It's
pleasure, Tony.
Absolutely marvelous as always. We'll probably see you next time with your Interbay hat on again. So
yes, absolutely.
Until
Thank you very
then,
much for the time.
Simon will remove you from the room. We are exactly back on time now. So thanks again, Matt, for that.
Perfect.
So back on schedule. Our next speaker is Luke Douse from Redwood Bank. This is Redwood's first time presenting our specialist mortgage web show, but it's a lender that we've been using for many, many years, and we've got a great relationship with them. But previously, the people that we deal with didn't really want to get behind the camera. But Luke's a recent-ish addition to Redwood, and he has presented at our shows before in the guise of another lender. So again, you should have received this from us this morning, which is the commercial and residential investment mortgage products with rates and everything else that you need. A little bit on Luke now. Luke is our business development manager at Redwood Bank, and he hasn't appeared yet on screen, so I'm just hoping he's about to appear. So I might just talk a little bit slower just until he does appear. Having had roles in sales, marketing as a relationship director, Luke has a broad range of experience which he uses to support his Redwood Bank intermediary relationships and wider business development activity. He has a keen interest in the commercial finance market and in relationship building to support Redwood's ambitious strategy for expanding its support for experienced investors and businesses across Britain. And there's Luke. How are you?
Tony, good morning. Really well, thank you. Thanks for having me on.
Glad you can join us and glad that we can hear you. I will just go to your interesting fact, which is he loves surfing and visits Cornwall every year to hone his skills, although this often just means perfecting the art of clambering back onto his board after he wipes out. I wouldn't even get on the board in the first place. We'd probably sink. But there you go. So a bit of surfing. So Luke, over to you. We're bang on schedule. So over to you. I'll see you in about 20 minutes.
That's fantastic. Thanks, Tony. Appreciate the introduction. Hello, everyone. It's great to be presenting today. Great to share a bit of insight into Redwood Bank and let you know about what we can hopefully do to support your clients. I'll give us a bit of a walkthrough in terms of the bits that I'll be covering today. I'll run through a little bit more about myself, a bit more about the bank and what we're looking to achieve on the whole. I'll cover the products the areas that we'll be working on, give you the insight into those areas, and a wrap up on some of the key information behind that you might help to identify ideal deals that will fit with Redwood. So jumping in, that is me, believe it or not. As Tony said, I've had a range of roles across financial services, in marketing, in sales, moved into the commercial mortgage space around 8 years ago and never looked back. Absolutely love it. Every deal is always that bit different, and it's fantastic to be able to try and find unique solutions and ways that we can take transactions forward. I joined Redwood about just over 12 months ago now. I've just had my first anniversary. Really fantastic organisation to work for, really growth focused, but it's got a really nice positive family feel, and we really pride ourselves around the communication comms that we're able to share and those relationships that we can build with our intermediary partners like Specialist. This is our CEO, Gary Wilkinson, who'd leading factor in setting up the bank, just giving an overview of what we're all about, offering simple residential investment and commercial property loans fast. We want to get deals in, be able to turn them around for you, provide a really good quality level of service. and to be able to deliver for clients. We're there to help experienced individuals, and we think there's a space in the market to be able to support. So in terms of the products I'll cover today, as Tony mentioned, and on the fact sheets you'll see we do have a residential investment product line which covers buy-to-lets, HMOs of all sizes and areas in there. But today I'm going to cover our commercial mortgages and where we're looking in that area. So that'll be semi-commercial properties. On the commercial side, anything that has an equal rental split between the residential and commercial parts would be considered commercial, or if it's commercially weighted, we'd again consider that as a commercial investment deal. We do commercial investment loans and commercial owner-occupier, and that could be in a range of guises. So a true owner-occupier where you have the trading business that owns the premises they're trading from, or different variations of an opco, propco. So it might be owned in a personal name, owned in a limited company, owned in a pension, for example, and their trading business is operating from the site. We deal with those as commercial owner-occupier lends. When we're looking at investments, we always look for it to be experienced commercial landlords. So mentions experienced investors there. We'd look to see that people have owned and managed lettings of commercial property for 2 years or more. So people that have purely buy-to-let experience in the background, we wouldn't consider those on a commercial investment transaction. We would look to see that it need to have had involvement with managing commercial leases, that type of negotiation that's in place. We're happy to look at single assets or portfolios for investors. That's not a problem for us. And we'll also look at expats on these transactions as well, subject to a few additional criteria, which I'll cover a bit later in the presentation. On the owner-occupier side, again, we're looking for established, experienced operators. So we'll ask for a 3-year track record as a minimum, looking for full accounts over that period so that we can assess and look to see the trends out of that and be confident that it's a deal we're happy to take forwards. We do understand the impact of COVID. Obviously, that was a massive thing for our industry. It affected businesses and industries across the country. So we understand that some businesses had to have times closed, their turnovers were impacted, their costs were probably impacted during that period because of supply chains as well. So we'll factor that all in when we're conducting an assessment and we're looking against serviceability, and we'll typically won't deduct the COVID grants, any COVID grants that people have taken. If we can see there was a realistic impact on the business, we'll allow those to stay in place. Some of the key features of the product is that we'll lend against the value, not purchase price. So this could be for a sitting tenant that's achieved a discount in negotiations from the seller, or it could be that someone's just negotiated a good price, a discount on the purchase of a portfolio. We will recognise the value that our valuer gives on that site. So if someone's getting a big discount, we can still look to get the higher level of funds out. We normally like to see a bit of skin in the game. Maybe 10% would be great, just to demonstrate that there is some cash being put forward by the borrower. But it does depend on the circumstances. So we can potentially lend up to 100% of the purchase price, typically sitting tenant deals. In terms of borrowers, as I mentioned, we're happy to lend to people in their personal names, be that individual or an informal partnership, to limited companies, LLPs, and to pension borrowers as well, SIPs and SASs. We'll lend up to 70% loan to value on the commercial side, and we can add our fee on top of that if serviceability works. It's quite a broad loan range. We'll go anywhere from a minimum loan of 125,000 up to a maximum loan of £8.5 million if across multiple assets. 6.25 million for a single asset is where we can look to get to. Rates typically kick in from 4.75% above Bank of England base rates on a tracker basis. And again, the expats are considered in this area. In terms of the type of commercial properties that we're happy to look at, that spans semi-commercial of all types, industrial, essential retail, and other forms of retail as well. And now we've expanded our appetite, although it has slightly higher debt service cover burdens depending on the area that the retail sits in. Mixed use, so that could be combined retail and office properties, for example. pure office, and importantly in this area, and somewhere where we've seen a lot of traction, is for pubs, restaurants and leisure as well. As long as we can see those businesses have a strong track record, they're well underpinned by financials and serviceability, and we've got experienced borrowers, we're happy to lend into those areas. And I've had good success of that this year as well on deals that I've had taken over the line. Mentioned on there, we have limited high street retail appetite. Poor example is quite a long time ago, but we're not looking for a Woolworths style building. Smaller units we still have appetite for, not the clothing retail sector at the moment. And if it's a pedestrianised thoroughfare in a main town, we're probably not going to look there. But if we're looking at smaller townships, secondary parades, anything like that, we still have a keen appetite to get out and support investors in those areas. So I just want to call out some of the areas where I believe that we're strongest and we see the most success in our transactions. Discounted purchases. So for an example, if we're only putting 10% in, but we've got a discount, that's somewhere we feel that we really stand out and we have a lot of success lending into the market. Multi-tenanted properties. So in this instance, you may have a collection of shorter leases that are in place that are only 1-2 years. But if we've got a broad spread of tenants, we're able to get our credit team on side, showing that, it's unlikely that all those tenants are going to exit at the same time. So we can get more comfortable with shorter lease terms where we've got that overriding interest for a number of different tenants in place. Again, expats, keep mentioning that, but it's somewhere that we do feel we stand out on investment deals. More than happy to support for people that are experienced and they've got a setup to help them manage in the UK. And strong serviceability and leisure deals. Again, we're going up to 70%. We're going to add fees on top of those. We know it's an area that's had some challenges. We do need to factor in areas around the way that we look at costs now. For example, the increased energy burden that a lot of businesses are seeing across the UK. That can be more prevalent, particularly in restaurant pub deals where there's a lot of energy costs that run in there. So we apply an additional cost when we're looking at the accounts to see that can work. But if we've got a sound business that has good fundamentals, they're profitable, and we can see that it's supportive, we want to make an effort to see that we're getting those deals over the line and giving support to the market in that area. Sorry. A few bits that I think are worth knowing about Redwood and our approach. We'll get our credit underwriters to formally approve a deal before the customer incurs any costs. So we'll take the application through from specialist. The deal will progress and we'll get it over the line with credit. At that point, we'd then look to go to offer letter with collect a facility letter fee, which is refundable at the end of the loan. Excuse me. And valuation costs, again, will only be incurred when the customer has that confidence that it's a deal we can take forwards. With smaller deals, I've mentioned that our loan sizes can kick in from £125,000. So if we're looking at a deal at the bottom of our appetite, we probably want these to be a slightly more simplistic structure. So kind of a single borrower, straight line through to the top, maybe less properties. We do consider all instances, and for deals that have wider scope, we're happy to look at those slightly more complex structures as long as it's understandable and it fits, and we're looking at UK borrowers. We're happy to get a head around those, but we're probably looking for more simplistic if we're at the bottom of our loan sizes. And we do seek personal guarantees. We know it's not everyone's favourite thing, but we will need it on each transaction. We don't necessarily need a full guarantee, is what I would say. We'll take a look at each deal, look at its own merits, and see what's a realistic approach to support the transaction. Obviously, when we're taking a personal guarantee, we'd like to see that the people behind the transaction, the actual applicants, the clients, have access to a reasonable amount of funds. There's no point us taking a £5 million guarantee against a £5 million deal if the people are only worth 100,000 in terms of net assets in the background. So Depending on the transaction, we may seek full, but we may seek as low as, say, 20% as a guarantee. And when we're looking at term lengths for a transaction, which are normally from 5 to 25 years on commercial deals, we look to go off the age of the younger applicant. I had a deal recently where one of the borrowers was 72 years old, but their grown children were younger than them, and they're involved in the transaction. That was going to be the succession plan for them. So as part of that, we did a joint and several guarantee across all parties to give us that confidence and longevity as the deal goes ahead beyond the age 75 for who was fundamentally the main borrower. Again, open to discussion in those areas when we've got a transaction that comes through. Our main appetite on commercial investment deals comes in at 500,000 and anywhere above that level. And ideally, we'd like to see a WALT, so a weighted average unexpired lease term of 4 years or more. And that's where we do an awful lot of our business, and that's where we see a lot of support from credit. That's not to say that we can't support other areas, but again, main appetite sits there. And then beyond that, it's strong commercial owner-occupier deals where we have a good track record of profitability, so our EBITDA can be used towards serviceability. We've recently launched fixed rates. So we've launched 2 and 3 year fixed rates in addition to our standard tracker Bank of England base rate variable product. The way that our fixed rates are approached is that we'll apply a margin to a transaction based on individual assessment. So each deal gets a bespoke pricing. You have Bank of England base rate that goes on above that, and then there's a fixed rate loading to allow us to secure those funds for the client for the period. After that 2 or 3 year period finishes, which is the same pricing approach, regardless of which option the clients went to, the deal reverts to the standard tracker basis, so margin plus Bank of England base rate for the remainder of term. So there's no falling off the deal onto an SVR rate. It means that the customer will be given that confidence that once the initial period ends, they will be able to carry on against an appropriate margin that's been priced specifically to their deal. We think that's a really good one for us. It means that we're still offering lifetime products, so we'll commit for the 25 years of the loan term, but the customer's time will only be for the period of the fixed rate. Early repayment charges would apply for the 2 or 3 years, depending on the option that they took. So after that, they can have a look. We can look at refinancing, capital raising. Obviously, our ideal is that the customers stay with us, but they have the freedom to be taken to a new lender at that time. But they don't have to. There isn't a hard cliff edge because they'll have the confidence that they're still getting a competitive deal when they come out the back of that period. With the expats, there's a few extra criteria that we would look at in order to be able to support in this area. So we'd want to see that there's a UK bank account, which is where we're being paid from and where the rent is being paid into. We'd ask for a UK managing agent to be in place. We want boots on the ground when it comes to being able to look after the properties. We had a couple recently that are living in the south of Spain. They come back only for a short amount of time each year. If they have a problem with their tenants, we want to understand that there's someone that's available to the tenants to help manage it and ensure that everything's stayed on top of. The other factor we look for is a UK process agent. Now, this is typically a solicitor's. There's people that will agree a fee that will go in place. So when the loan launches, it means that there'll be someone in the event that we hope wouldn't happen, but say we had to serve notice on a property, we'd be able to serve notice to a fixed permanent UK process agent, a permanent address that would be able to act on behalf of the client and ensure that we could serve any details that we needed to. And again, individuals, partnerships, UK limited companies, all fine in this structure, as long as it's a UK-based entity or UK expats, as it would be with individuals. And just want to call out some of the areas are unique selling points to cover these again. So just to reiterate, we lend against the valuation figure rather than purchase price. And that's typically the lower of market value and vacant possession value. If we have a deal where there's 10 years left to a council, for example, that's letting, then we may be able to look to the market value position and look at market rents as well in the same breath. Where we've got local covenants in place, we'll typically be lending to against the vacant possession figure. If we can see that when the tenancy ends to the current tenant, as it was at that time, if we can see the deal would have amortized to a point where market rent, if it was being over-rented, market rent would still support the loan at that amortized period, we may be able to argue to credit team there to allow us to use the higher figures. So that gives us an additional level of flexibility to help drive out a higher gearing if that's what the client's looking for, again, individually on a case-by-case basis. We are happy with corporate lets on the residential element, so this covers our buy-to-let, but also for semi-commercial properties where you perhaps got shop with flat above. If that's being let out to a council, a charity, Serco, for use for housing people in any type of social situation where they need assistance, we have no problem with that. We're more than happy. We may want to understand what the terms of that lease would be. So who's responsible for repairs? We'd like to understand the length of lease, what the details are around breaks and that kind of area. But we have no problem, and that's somewhere where we do an awful lot of business, particularly, for people that are perhaps in a halfway property that are coming out either from children that have left fostering care and now young adults and needing places to stay. We've done this for help with people that are ex-offenders that are now working through and moving back into the community, and helping the homeless, other people who've had substance issues in the past. We want to be able to offer support to all of those areas. So as long as our tenant that we can see is in place is a larger body that we can see in place, we have no issue with that at all. In terms of being open across most sectors, we know that a lot of people are having challenges with this. We really want to stay lending in as many areas of the market as we can, and it's just for us about picking the right transactions, the right deals that are worthy of support with the right borrowers behind them. So again, a broad spread that's in place there. And for semi-commercial, if you have a flat that's being used as an HMO, that's absolutely fine for us as well. I mentioned minor wrinkles. We're not keen on businesses that have had substantial liquidations or areas in that kind of past, but we do take a common sense approach. There isn't a specific box. If someone's had CCJs for water bills because their tenant left, the post didn't get forwarded, if we can understand the narrative around that and we can see that those payments have been brought up to date, we're not going to hold it against people. It's just about understanding the picture of what happened at the time and how they've overcome it to today. Like I mentioned again, our maximum loans up to 8.5 million and single asset up to 6.25 as we stand today. Hopefully that gives a bit of a broad overview of where our appetites sit in the market. Tony, I hand back over to you. Thank you very much.
Luke, thank you very much indeed. No questions from the delegates, so I'm going to go straight into the questions you set yourself. There's a couple of good ones here. How do you approach deals where people are acquiring a trading business?
Okay, so when we're looking at trading business performance, we'd want to see that the individual has had experience in that sector before. So if you've got someone buying a pub that they want to run, we'd look to see that they have had experience owning and managing a pub in the past. They don't have to own one at the moment, but they would need to have operated it in the past. We'll work on the accounts for the business, looking back historically, so we won't include forecasts and additional revenue streams that people are looking to add in place. We'll see that the transaction works on that basis. In another instance, if we've got someone that, let's say they own a fish and chip shop now, they want to buy a new fish and chip shop, it might be that we don't have evidence from the new business that it would be able to support itself, but there was sufficient surplus from the EBITDA from their current business, as long as the ownership was going to be contained in the current business, we could look to work everything off their existing trading entity, and that would give us the serviceability for the new deal. So we do try and be as flexible as we can in that approach.
Okay, question from Caroline Hughes. Morning, Caroline. Will you lend to churches, and will they also need to have commercial experience? And this is a church wanting to buy their own premises.
Caroline, thanks for the question. Unfortunately, it's not something that we'd be able to support. There's a few reasons for this. One of them is around the certainty of income. As with churches and with many charities, it's about where those income streams come from. A lot will be from donations rather than personally generated revenue, which can be more difficult. There's also a bit of a risk for us around, if we were to repossess, the reputational side of looking to oust people from a religious building and so on is really challenging. And the third part is we always look for personal guarantees on transactions, and in our experience with churches and charities, that often can't be made available just because of the community network of the way they're approached. So short answer, not one for us, I'm afraid.
Okay, another one of yours. What is Redwood's standard process for progressing new opportunities?
Well, we'd like you to route everything through to specialists. As Tony said, we've got a really great relationship. We'd love to be able to work with the team there. We're happy to have conversations by phone. We'll chat deals through, and we'll look to give an insight into what we can do to support a transaction as early as possible. So headline terms to come back, giving details of the loan, margin, term, repayment profile, early repayment charges, anything and everything that we can provide up front, we will do so. Applications come into us typically electronically, normally come back by email, PDF copies, that kind of area in the first instance. When we take a deal forwards, we'll look to, at that point, take everything on, we'll conduct searches, checks, and be able to take a deal forwards to get it to credit underwriters. We'll come back if we need to ask it for additional information and get it to that point of approval. Once we get there, or as part of the approval, depending on the size of the loan, we may want to have a meeting with the customer. Often we can do this by Teams, and for smaller, more straightforward deals, it may not be the case that we would need to meet or speak with the customer directly. But we do reserve that option depending on the makeup of the deal. And we've got a fantastic support team that works for us once a deal is approved and goes to, some people call it completions, we call it credit ops, and they'll work and liaise closely with the solicitor parties to get a deal over the line. And I'd just add on solicitors, if we're doing a refinance deal, Tony, we can look to do sole representation, so we can get quotes from our solicitors panel to represent both sides of the transaction. If we're doing a purchase deal, we will look for separate representation to take the deal forwards. But if we can do something that saves the client costs and gives a more straightforward process, we're certainly happy to do that as well.
Nice one. Luke, thank you very much indeed. Simon will remove you from the room as a speaker. You can obviously still continue watching if you wish. Okay, so our next or final speaker is Matthew Batte from Pepper Money. Used to be known as Optimum Credit. They were bought out by Pepper 4 or 5 years ago, rebranded, I believe it was last year. I don't know, it's all sort of, the last 3 years has all sort of gone by in such a way that it's difficult to sometimes remember what's happened when it happens. So there is. Can you hear us, Matthew?
I can indeed, yes.
Fantastic. Right, good. Nice one. So straight on, you should have received this. This was one of the reasons why the email was so large, because we didn't realize these were 3 megabytes each document.
Oh.
But there's the 2 broker packaging guys, and I think Simon, my head of IT, is reducing the size of those to resend them just in case you haven't received them. So probably everybody will get them again at some stage today, but you should have those. Okay, a little bit about Matthew. Joined the world of finance back in 2007, has worked as a broker in second charges for 11 years. Before joining Optimum Credit, now Pepper Money, he worked at Shawbrook Bank as a senior relationship manager covering second charges, buy-to-let, commercial finance and bridging. Matthew now covers the whole of the south for Pepper Money second charges. Interesting fact, Matthew went on an unusual route to financial services, training in Mount View Academy of Theatre Arts, where he studied musical theatre. That's a strange one. After a short stint doing theatre tours, short films, and some feature films, he decided to make second charges his preferred career. That's not one I've heard before. Okay, normally people fall into second charges for whatever reason, as I did. Certainly, that's not something I ever considered to be my preferred career, but I've actually really enjoyed it over the last close on 40 years. So, Matthew, over to you. I'll see you in about 20 minutes, and there you go.
Thanks very much. Thanks, Tony. Okay, hello everybody. So my name is Matthew, and I'm here from Pepper Money to discuss everything second charge mortgages. Okay, so what I wanted to go through today was basically some of the myths surrounding this type of product, because historically, second charges have been around an awful long time. Or secured loans, as they were called, one time as well. And obviously they get a bit of a bad rep back in the day. And I do find when I'm out and about chatting to people that this is, some of the reasons why people still don't necessarily consider seconds, because of this kind of old reputation that second charges have. So we'll have a look at some of those. Obviously how second charges can really benefit your clients, be a key armory in your toolkit when looking at the whole market and the best outcome for your clients. Have a quick look at what our typical customer looks like, because that always really helps for you to kind of see what kind of customers we see, and then also how to access the products as well. So if you do have any questions throughout this, please make a note, and we'll run through them at the end. So previously, back before, so we're going back before FCA regulation, before MCD, there was the second charge market was an awfully small, flat market. It was there really. There were what we call prime lenders and subprime lenders, but I guess there was more a kind of stress on kind of credit repair type of things, so not necessarily the best applicants in terms of credit profiles or proof of incomes, all those kind of things. There were an awful lot of larger fees, so that could have been down to lender fees, packager fees, whatever that is, complicated ERCs as well. Very often some of the ERCs weren't actually, a lot of clients wouldn't necessarily know they had an ERC, what it was going to be, until it came to that point that they were redeeming the loan. So there was an awful lot of hidden charges. Obviously, a lot of the time, PPI was sold as well. All in all, quite a poor experience as well for people. Obviously, there were poorer regulation as well. I mentioned that this is prior to MCD. We weren't regulated back then by the FCA either. So all in all, I can understand why people did have this kind of misconception about, why you would look at second charges and have this misconception that potentially seconds are still like this. So what I want to do is kind of go through that now and kind of tell you why that isn't the case. So obviously right now we're aligned to MCOB, MMR, MCD. Ultimately, when you're looking for the best outcome for your client and you're looking at a further advance, or just an existing client of yours is coming to you to raise further funds, you have to basically look at all options available, and second charges is a key one of those as well. We are basically a regulated mortgage product, exactly like a first charge. So there is no difference whatsoever. It's just the fact that we are ranked second charge behind the first charge. The documentation that you'll see from any second charge lender, this is not just ourselves, the ESIS, the mortgage illustrations, they're pretty much identical to what you see on the first charge side. Fixed rates, the interest rates are outlined there, how long they're valid for, whether or not there's any ERCs to get out of that within that fixed period, how much those ERCs are. Obviously, the APRCs as well. Everything is laid out exactly the same. So a bit then about us as well. So Pepper Money, as Tony mentioned as well, prior to becoming Pepper Money, we were a lender in our own rights called Optimum Credit. So we've been around as a lender for an awful long time, and we've always had this reputation of being a very quick lender. We don't publicize any SLAs, because we get a case in and we work it that day. So ultimately, if you submit a case to us, let's say up to 3:00 in the afternoon, you will get a day one update that same day. So if speed is key, and you're coming to do a second charge because you need to get the funds quickly, then we can look to get completions in under 2 weeks. Now, this takes into consideration the whole process from the sourcing and the advice throughout, and the packaging all the way through to making the offer and then completion. Now, that's an average. Very often things can be quicker than that. Ultimately, if you've got a second charge that doesn't need evaluation, because I'll go into this in a bit more detail in a moment, if you don't need evaluation because it passes on our AVM criteria, if you don't need any information from the first charge company, so that would be a letter of consent to register a second charge. If there's no restriction on land registry, then we don't need that. Really speaking, you could get a completion in more like a week. It doesn't always happen, because very often, if vals are needed, you're at the mercy of a surveyor and their availability, and the same with any consents that are needed, because then you're relying on the post ultimately. And we've seen an awful lot of postal strikes recently that have caused some considerable delays, unfortunately. But in essence, if you have a perfectly packaged case going up to us day one, we very often see day one offers. So speed is one really key thing that Pepper Money are absolutely great at. Now, I mentioned in the previous slide about fees. Now, fees are massively reduced now in second charges, very much in line with first charges. So you'll see variable rates, a couple of our fixed rates with 595 fees. Some of them can be higher than that. We do have some discounted products. So with the discounted products, you might see a higher lender fee. But they're massively in line now with first charges. Now, talking about our products, we've got a range of different products available. A variable rate, which doesn't have any ERCs. And then we have some fixed rate products, so a 2-year fix, a 3, 4, and a 5-year fixed product. Now, we also have, which seem to be a little bit more popular now with what's happening in the market, is our discounted rates. So we have a 12-month discount, a 24-month 36, and then a 60-month discount product. Now, we also do have a little hybrid interest only. So it's not a full interest only for the full term. It is only interest only for the first 5 years, and then it switches to capital repayment after that. But again, at Pepper, one thing that we have over a lot of our competitors is we have an awful lot of different products available. So we offer loans from £5,000 up to £1 million. We won't breach that £1 million, unfortunately, but very often our average loan is considerably less than that anyway. But the other big thing that you'll probably see on that screen is that we lend up to 100% loan to value. So 100% loan to value, you might be panicking, thinking, wow, that's an awful lot. You were just telling us about the crazy times and how things are different now. Well, we are capped at 100%. There's no 120% products, but the 100%, and I do have this conversation quite often, is that you shouldn't be necessarily concerned about going up to such a high LTV, because the vast majority of our high LTV products are for home improvements. So if you're looking at a home improvements loan and you're going up to 95%, but you're actually putting a dormer with an ensuite upstairs, actually, when you come to refinance that and wrap it up into a first charge in 2 years, 3 years, whatever it is, the valuation of that property you would have thought would have increased because of the home improvements that have been done. So then you're going to be wrapping that up into a remortgage, probably then at a more realistic LTV of 80 or 75%. And then the other thing to think about is debt consolidation. So you mentioned home improvements already. Debt consolidation and home improvements are our most common purpose for a second charge. And consolidation as well is another good reason why you would look to do a second charge, especially at high LTVs, because as we know, first charge companies may restrict actually the amount of debt consolidation that can be done, or actually the LTV that they will go to if there is any debt consolidation being done. So again, we're putting the clients in a better place by paying that debt off, consolidating it into a secure debt, and then when you come to remortgage that again, when wrap it up into a first charge in again 2, 3, 4 years time, then it's a secure debt, so it won't be classed as consolidation at that point. Another good thing about us, and to aid with the speed as well, is it's a complete digital journey on our portal as well. So at DIP stage, you'll know if that particular application, you'll know your rate first, and you'll know if a valuation is required. We've got credit searches built in, EID built in, a whole case tracking all built into the system as well. So actually, speed from taking you from DIP through to completion is really pain-free, all done on our system. Now, I just want to also mention, I mentioned about the rates there. You'll see that we don't kind of advertise rates from X amount, or I'm not quoting you rates up to 100% loan to value. So a little bit about that and why we don't quote rates. Now, we have a bespoke pricing system, basically. So when we first launched into second charges, there was an awful lot of other people doing the same thing. So we wanted to kind of stand out from the crowd. So we actually launched this portal that had complete bespoke pricing. So it's bespoke pricing all based on customers' individual circumstances. So you never really know what you're going to get until you do a dip with us. But having said that, of course, you kind of need to have an idea of rates. Now, we have seen rates increase across the board in first charges and second charges over the last couple of weeks. And I'm sure you've probably all got a split screen on at the moment with the BBC News that's informing you of the base rate change that was due at 12 o'clock. So rates have increased. So we were, at the beginning of the year, with our discounted rates, probably seeing rates from 2.9. That has very, very quickly changed, and really with a variable rate now or a fixed rate, you're probably looking at rates starting from around the 7% mark. But even that, we're talking about debt consolidation a lot. So, the rates of 7s and 8s, when people are still getting their credit card statements and seeing that their interest rates on their credit cards have gone from 19% to 24 or from 28 to 32, when you actually look at it as a whole, when you're looking at debt consolidation, if we're able to take those debts, reduce outgoings, and still free up £500 or £600 a month in your applicant's pocket, that's a pretty good situation to be in, especially right now with increasing costs. The next point there is the legals point. Very often I'm asked about legals. And does that delay things? What is the process? Well, there's pretty much no legal process involved. That's all done post completion with our in-house solicitors. So yeah, I'll jump on to the next slide. Okay, so here are some really good examples of why you would consider a second charge over a first charge. So I mentioned before with the speed, because if speed is what you're after, then that is one of the reasons why you would potentially choose Pepper Money, because of the fact that we're able to give you those updates within 24 hours, work cases, and get an offer to you all through the portal, potentially within an average of 2 weeks, but very often quicker, as I said, if valuations are not needed and so forth. So speed is a big one. Obviously, this is the key right now, isn't it? That people don't want to lose their existing interest rate by remortgaging. Now, I used to mention on there about lifetime trackers before. So you're looking at those old G Money, Cheltenham and Gloucester deals that were ridiculously low trackers. Well, now it's switched to everyone that's remortgaged, I don't know, 2 years ago on a rate of 1.1 or 1.4, you'd be absolutely mad to jump and move away from that right now. So looking at a second charge is probably your best option at that. And then, as I said, wrapping it all up into a remortgage at the point that fixed rate comes to an end. I've still seen an awful lot of people with interest-only mortgages. So obviously interest-only, switching across to a repayment mortgages obviously could have a massive impact on affordability and just probably would not pass, especially with the with what's happening with the cost of living right now. That's going to be a big obviously have a big impact on that. Now, of course, and again, people always ask me this, well, wouldn't a further advance be cheaper? Yes, of course. Now, during your process, your advice process, of course, that's one of the things you would probably look at first and foremost. But if a further advance, isn't accepted for, it could be from a multitude of reasons. It could be because someone's recently changed from being, employed to self-employed. You could have had someone that during COVID, their self-employed business has really been impacted and their income has dropped massively, or even as a result of COVID, their business has unfortunately had to close, and then they've switched to an employed role and haven't been in the role that long. There's all sorts of kind of different reasons. LTI could be another one. So we all know that the loan to income on first charges is a lot lower than that we will accept on second charges. And with ourselves, we have a loan to income of 6 times on our prime offering. And then we also have a product that doesn't have a loan to income calculation. It's all based on affordability. So providing that you pass our affordability calculation, your LTI could be 7 times, 8 times, 9 times. It doesn't matter. We will still do that deal. A little caveat there. Obviously, I don't want to go into too much of all criteria-based stuff, but if you are looking at our no LTI product, that is capped at an LTV of 80%. So slightly less LTV on that one. Now, it could also be around the purpose of the loan. And this is where we see an awful lot of business as well, is around tax bills. So if you've got self-employed applicants and for whatever reason, it could be an emergency at home, the old classic boiler breakdown or a leak in the house, or it could be business related things like COVID, and they had to dip into reserves, and those reserves were there for tax purposes. We're seeing this all too often now, but we will look to repay tax bills. We will also, so that's personal tax bills, we'll also look at corporation tax as well. They always need a referral because there's a lot more questions to kind of look at. Then we need to look at the business, how the business is performing. Obviously, when we're looking at paying off tax bills, how the business performs is crucial, because if the business is deteriorating or we're eating away at retained profits year on year, that would be an issue. But providing that we've got a healthy business going the right way and a good explanation as to why the tax is not paid and what's in place to ensure that the tax will be paid in future years, then we will do these. But I mentioned the debt consolidation anyway already. That would be a reason why you would look to do a second charge, because you're capped at the LTV and for the actual amount of consolidation. The ERCs on the first charges, standard. I don't need to tell you guys about ERCs. You're all going to be fully aware of all that. The failing on the affordability, I've kind of mentioned this already around the LTI or the change of circumstances, or it could just be that they've had a blip in their credit file. These are the things that we will look at. So again, because we're a bespoke pricing lender, we don't actually come out and say to you, do you know what, if you've got a CCJ or if you've got a default, we won't consider, or we will only limit it to 6 defaults in the last 12 months. We are completely bespoke. So providing that the client hits our kind of minimum scoring in the background, you will be offered a product. So that could be someone that has had a mortgage mispayment in the last 6 months, could be someone that's had multiple defaults in the last couple of years. You could even have somebody that's currently in a debt management plan. So if you've got somebody in a debt management plan, we will consider to do that loan. We can pay off the debt management plan, or we can look to actually leave the debt management plan in place and just lend the additional funds to them. Because let's be honest, an awful lot of these debt management plans were taken out an awful long time ago now. Could have £25,000 in that debt management plan with interest frozen, paying a very low amount towards that. And let's be honest, is it really good advice to switch that kind of interest-free low payment into a secure debt? Probably not. So we've got the products there that we can leave those debt management plans in place. Also I mentioned as well the credit card interest rates. We're seeing interest rates now increase on unsecured credit. So even more so now, those people are becoming so much more aware now of the high interest rates that credit cards companies do charge. That could be anything from high teens up to high 30s. So if somebody does have an awful lot of debt and is paying those kind of interest rates, then obviously a second charge could potentially be their best option. This slide quite simply gives a second thought. So very often, what we're seeing now is an awful lot of people, and we have done over the last couple of years, is more and more people go across onto 5-year fixes on their first charge. Obviously, there's been some very, very good deals around. And all that does is kind of it locks that client of yours away for 5 years until you kind of give them that call or drop them an email 6 months before their term is up, and where you start to talk about a PT or further lending or whatever it might be. But all these applicants that you've got, all these clients that you've got, are still obviously going to have needs. Now that could be around the debt consolidation that I've mentioned, and you're probably sick of me saying those words, but it could also be around changing circumstances with family. They could have parents moving in with them because they're elderly, or they could be a young family, and within those 5 years they've gone and had 2 children and need to extend the house. They're still going to have needs within that 5-year fixed period. Now, if you're not considering second charges, I can assure you somebody else will, because all they'll do is they'll go online and start tapping away at looking for a £30,000 loan, and they'll end up going to one of those big your money supermarket and all that, go compare and just be farmed off to a broker, and then you won't see anything off the back of that. So please do, just with your next case, just give second charges a second thought. Corny, I know, but hopefully it might stick. So some of the other kind of reasons that you would turn to do second charges, matrimonial settlements. So if you've got somebody that has gone through a divorce, they're living in their property, but they need to raise some funds to pay off their ex-partner, that's absolutely fine. We can look to do those. Home improvement, debt consolidation, don't worry, I won't mention it again. School fees, car purchases, obviously holidays can be, with car purchases and holidays, you wouldn't necessarily think, let's take a second charge out for that, but that's often the secondary kind of purpose. Or somebody might take loans out to do home improvements and purchase a car. Legal bills, tax bills, buy-to-let purchases. This is a really good one that we do see an awful lot as well, and where we're quite flexible with as well. If you've got somebody who's first-time landlord or just looking to get into the buy-to-let world, that's absolutely fine. We can look to do an outright purchase, taking funds out of their resi to do an outright purchase, or it could be towards a deposit for that buy-to-let. The only thing that we will do, where we do have someone that's inexperienced like that, then we would stipulate that those funds need to go to the conveyancer who's dealing with the purchase. But if you've got an experienced landlord, and we're using income from UK Land and Property or from an SPV because they've got multiple various units, then that's absolutely fine. We can potentially then give the funds directly to them, so that they can go to a auction or whatever it is to purchase a property and actually have the funds readily available. Same goes with any holiday lets. So if you've got Any holiday home purchases, if you've got somebody looking for that, or for second homes, we can always look at those as well. Or taking money out of a property to gift to a child. We see that an awful lot, and I'm sure you guys too now, with the rates increasing the way they are. It's becoming increasingly difficult for first-time buyers to get on the property ladder. So if you do have applicants that are looking to just take £50,000 or whatever it might be out just to gift to their children, that's absolutely fine, and we can consider that as well. Business purposes are on there. All I would mention about business purposes is that as long as it's not a business startup, then we will look to do, I said, we can look to do that. And very often what we see there is, looking to purchase land, or it could be larger premises to trade from, or machinery, or it could be, it could actually even be to buy into a franchise. Now, again, we don't do business startup, but with a franchise, it's slightly different. So again, business purposes always have to be referred in, because there's a lot of moving parts and not one case is the same. But best thing to think is, as long as it's not a business startup, then we can consider it. Now, if you do have people with complex income, we take all sorts of income. So your standard employed applicants, self-employed applicants, great. With our self-employed criteria, you actually only need to be self-employed for 1 year. So we need to have that 1 year's trading, and we can consider. We take all manner of benefits as well. We can look to take, and then the more, I say unusual, but it's a lot more common now after the world of COVID. People on fixed term contracts or 0-hour contracts. Day rate contractors, people working under umbrella companies, CSI workers. We will look at any type of income that your applicants have got. Ex-local authority properties as well. We're one of the few lenders that will ignore the preemption. So if you do have cases where people have purchased their right to buy a local authority property, we can lend to them within that first 5 years. So we ignore all of the preemption period. And really quickly, because I know I can see you on there, Tony. Really quickly, just quickly show you the typical customer profile. And I think this is really, really key, especially when a lot of people do kind of think, oh, second charges are for people, low earners, high LTV, bad credit. When you look at this, it's your kind of your perfect client, really. 42 years old, so plenty of time left when you're looking at the term for the mortgage. Average household income of 72,500, really healthy property value as well of 428. And the big thing as well, even though we do 100% loan to value, our average LTV is actually only 65%. Very good credit score of 450. And the vast majority of applicants as well as employed. Now, some of the rates have changed there now. I mean, you can just see 91.5% are on some sort of fixed, and with 75% on a 5-year fix. That's gone up massively now. Last month, we were at 90% on a 5-year fix. So the vast majority of our stuff is now on a 5-year fix. But ultimately, that just shows you that this is your perfect client, basically. So a lot of the clients that you guys will deal with on a day-to-day basis would be the perfect applicant for a second charge. And of course, to access the products, you need to speak to Tony and the team. You go to, because these guys are specialists in this field. They'll have all other, not just us, Pepper Money, every single second charge lender out there on panel. So you know that when you go into somewhere like Specialist, that you're going to get the best advice and the best product possible for your applicant. Yeah, that's pretty much it. I always tend to talk far too much. But the main
thank you very much.
Is just to consider second charges and give them a second chance.
Absolutely, completely different market to when I started, which was before 8-day calling off periods, which then came in 85, and because it was the Wild West before that.
Yes.
And things like Rule of 78 redemptions, which were horrendous. You could borrow
Absolutely.
money, and 10 years later, you'd actually owe more than what you actually borrowed. It really was quite ridiculous. It is now a mainstream product. I know there's a lot
Absolutely.
out there that still don't consider it, but I do know the FCA and all this consumer duty stuff I'm going to be talking about in a little while that's coming up. You really do need to consider it. You really do, because if you don't, someone, like Matthew said, someone else will. One more thing I'll just say about Pepper. When they launched as Optimum, I always say when we have a second charge lenders, only 3 occasions in the time I've been doing this have I gone, wow, that's a game changer. And Optimum's product, when they launched it, really was a game changer, because it just was unlike anything else in the marketplace. And you could have clients, and our cheapest loan, I think Matthew mentioned 2.9. I think we had a 2.9% APR with no valuation fee, and it went through in a week, and it was as simple as you could ever find. It really was. But Matthew, we've got no questions from the delegates, and believe it or not, you've actually answered all 4 questions you set yourself already. You've already spoken about all of them at length, so I won't bother reading them again. But
the one about the because I mentioned about the legals, I probably should have gone into a bit more detail, but just purely that we have in-house legals ultimately, and all the legals would be done by yourself, wouldn't it, Tony? Anyway, because the only thing
pretty much, we do the loan registry searches, and then the lender will just issue the priority search so that they can get the charge registered on the day of completion, just to check no one else is trying to lend money on that property.
Absolutely.
And there's no solicitor's involvement. So it's such a simple process, and that's always been the way. I'm surprised that first charge lenders haven't taken on the same process for standard remortgages, because there's no need to go through the process that they go through. Caroline just asked, are there any lenders you won't lend behind?
Not really, no, there aren't. There used to be back in the day when you'd have the more obscure lenders, but the vast majority of them have now been taken over or being managed by Ascendant and people like that. So actually, no. The only thing you've got to be careful with is that there are some lenders that won't grant consent. First Direct is one that comes to mind, that if you do need to get consent, they won't grant it. But apart from that, the vast majority do grant consent, and we will lend behind them.
That's right. We don't tend to have problems these days. You might come across the odd Mortgage Express residential mortgage, very, very rarely though.
All those obscure ones. I think
all sorts of nonsense. But it's very rare. When second charges came under FCA regulation, funnily enough, lenders stopped refusing consent because it's not really their choice. It really isn't. So Matthew, thank you very much indeed. Simon will remove you from the room, and I will crack on with my bit, and we'll see you again soon. Come and see us.
Thank you, Tony. Thank you all.
Right, everyone. So this is my bit, the final part, just at the end. I've got slightly less time than I normally would have, but we are still sort of on schedule. But so I always start with a little bit about what's happened recently. Those of you who don't know, base rates have gone up to 3%. I've just been keeping an eye on it, and it was announced a short while ago. So expect the same nonsense as we've been experiencing recently to continue. But a little bit about what's happened recently. Normally it's what happened in the last month, but it's all now just all in one. But it's still carnage out there. But we are seeing some green shoots. We had a second charge lender, for example, yesterday, who issued a new set of rates. Their 5-year fixed rates dropped by up to 1.5%. Now, that could, of course, mean that their rates were too high to start with, which is possibly the situation. But we are starting to see something a little bit more sensible. Of course, base rates have gone up today. I know it's down to swap rates on the fixed rates, but let's see what happens. But we are seeing some green shoots. We are seeing a little bit more confidence after the last 6 weeks of absolute nonsense that we've all experienced. And it's not been a fun time to be a mortgage broker. It really hasn't. We've got FCA consumer duty. I'm going to cover this in a minute. Just really, 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 I'm told that this is the biggest change within our market in 30 years. I'll be honest with you, I cannot understand what is behind some of this. I really cannot, but we'll come on to that in a moment. Still a chance. I'm still hearing rumours that the government is considering merging the FCA with the PRA, the Payment Systems Regulator, I believe it's called. A thorough review is going to be taking place. It depends who they've got in, which MP they've got in place in that particular role. But we're still hearing rumours that is being considered. Couldn't get any worse, could it? Let's face it. A massive changes to the appointed representatives regime. 3,400 networks and principal firms, 37,000 ARs and IARs. And again, I'm going to come on to that in a minute, because about 30% of the sign up. So people, you that are signed up today, are appointed representatives. And it's probably concerning times for you. It really is. So Consumer Duty. This is this is something that I took from the FCA website last night. So it's up to date, as as it could be, and it requires firms to act to deliver good outcomes for retail customers. I thought we was already doing that. I then put in red cross-cutting rules, okay, which I'll come on to in a moment. Cross-cutting rules require firms to act in good faith, already doing that. Avoid foreseeable harm, doing that already. Enable and support customers pursue their financial objectives. Yeah, we're doing that as well. Just on cross-cutting, when I read that, I thought cross-cutting, as far as I'm concerned, is what happens when I do my back lawn in sort of April, May of each year, trying to get it looking nice. It never works. It never does. So I thought, I wonder what the FCA are talking about. So I actually Googled cross-cutting, and this is what I come up with. This is the Oxford Dictionary definition, which is cutting wood or stone across its main grain or axis, or a technique, especially in filmmaking, of interweaving bits of two or more separate scenes. So what does cross-cutting mean when it comes to financial services? I'm going to see there's probably some 25-year-old idiot has decided I'm going to come up with something that everyone's going to go, oh, I didn't know what that means. Oh, I just absolutely, because you then see the third bullet point, 4 outcomes, consumers receive communications they can understand. Well, how about starting with us? Because some of the stuff that I've seen, it is an absolute nonsense. It really is. Because we're already doing all of this. It's all part of what we're doing, but now we have to, well, we've always had to prove that we're doing it, but now we've got to prove that we're proving we can do it. I just don't know where they're coming from at times. And I'll be honest with you, nor do the people that give us the compliance support, NACFB, Simply Biz. It's like, what on earth were they thinking? So this is what we've got by the end of 2022, October. So last month, firms board should have agreed the implementation plans for the FCA's new Consumer Duty. I'm the sole director of my company. My wife's a 50% shareholder. We had to have a board meeting and put board minutes in place showing that we were implementing the FCA's Consumer Duty. So if we didn't do that, then the FCA, if they decided to visit, come to my door, could say, you've not taken this seriously. So board minutes was something that we've been told we have to do anyway. And firms have to be able to evidence they've scrutinised and challenged the plans to ensure they are deliverable and robust. Who writes this nonsense? You just couldn't make it up. So there you go. We've got to share the plans, board papers and minutes with supervisors and be challenged on their contents. And this is just half of the 18 Consumer Duty project points that I am now required to complete with the help of the NACFB, because they've come up with a load of stuff, checklists and all sorts of stuff. I could have shown you some copies of what I've got to go through today. And I look at it and I think, how on earth am I supposed to get through all this? How on earth am I supposed to demonstrate most of this? Because you read some of those and they might as well be written in Mandarin Chinese, to be honest. They're just an absolute joke. So it's something we've all got to do. Those of you that are ARs, obviously it'll be your networks that will be involved in this. But of course, there's issues coming up in that side as well, because we've got this. So the appointed representative regime, the FCA decided on the 3rd of August, once they issued their policy statement, there's going to be loads of changes, and networks and principal firms have got until the 8th of December. That's 4 months. And the changes are massive. The cost of these changes is massive. That alone is going to cause problems. So expect networks, and this isn't my word. These aren't my words. These are the words of some very senior people within our trade organisations. Networks are going to cull ARs, increase their charges. And I know that many ARs, I've had 3 people contact me this week saying, I'm looking to deauthorize. What can you do for me? Because they just don't want it anymore. They're sick to death of it. It's an absolute nonsense. I've always had this in the back of my mind that maybe what the FCA want is for every client to go to the big lenders, the big banks, the big mortgage lenders that are out there. Let's face it, that's where the director of the FCA will end up once they finish their term with the FCA, normally on a £3 million a year contract of some sort. Maybe that's a cynic in me, but I just find all of this is 2003 FSA meeting. We were told that the mortgage regulation was a sledgehammer to crack a nut. Now it's a tank. It's a JCB to crack that nut. It just is not going to get any better. It really isn't, with the nonsense and the people within the FCA who have no idea what we do and how advice is given, and have never, probably half of them can't even spell the word mortgage. In one case, actually, it was somebody at the FCA who couldn't spell the word mortgage. It is a nonsense. But we got to put up with it. It's the way it is. But anyway, that's me getting that off my chest. So a little bit of information about us and what we can do for you. Quite simply, we see what we do as a partnership. We do not use the term master broker. I think that's a horrible term. It's quite simply a partnership, and we see you as a broker partner. So it's about two entities trusting each other. You trust that I'm going to pay you when I say I'm going to pay you, that we can do what we say we can do, that we've got the products that we say we have. And we've got to trust, obviously, if you're passing the client over to us, you don't try and hide this, that, and the other. And also situations, we've had situations in the past where someone's made a phone call. I've got a client whose property value is this, his mortgage is this, what will the rate be? And we say, well, give you an indication, but we need more information than that. No, I just need to know what the rate is. And we give them the rate, and they come back 2 weeks later with the deal, and we quote a rate. Well, that's not what you quoted me before. Well, you didn't really give us enough information before. So it's about, obviously, it's about a little bit of common sense going on as well, and also understanding there's still some lenders out there who are either not lending at all, or whose lending is so restricted that we can't get what we could get 9 months ago. It's not available anymore. We want to help you grow your business. I want to make sure that everyone that we do business with, every broker partner, is up to date with GDPR, that if anything happens to them, they are covering themselves, that they are finding out ways of generating new business, which is the reason why we run these. It really is. It's not just so you can hear different lenders. We run these to make sure that you're going to be around a long time. 2008 or 2009, two problems I had: no lenders, and half of the broker partners I had were no longer in it. They're gone for one reason or another. So we want to make sure you're around a long time. Doesn't matter what your FCA status is, although the not authorised part, my PI cover will no longer cover regulated deals from non-authorised people where a payment commission is involved. So those days, unfortunately, are gone. I want to make sure you stay compliant, hence the reason why we do all the giveaways and writing business indefinitely. Our products, everything except for equity release. So literally everything you can see on the slide there, from regulated bridging, unregulated bridging, buy-to-let, second charges, the whole lot. Our service packaged or introduced only. If you want to give the advice, you can do. If you want to give the advice on a second charge, but not on the commercial deal that you've got as well, you can do it whichever way you want. If you're going away on a holiday and you know you're not going to be around to deal with the case and you just want us to give the advice, we can do that. And when you come back from holiday, you want us to package, we can do that. It's your choice. Every single deal, we ask the question. There's not one scenario we can only offer you a package service or an unpackaged service. It's your choice, as long as you've got the permissions, of course, to actually do it. And it's not, and then why are we different? Well, it's not the products we offer, because we offer pretty much the same as everyone else, although we do, and I'm about to announce, can't do today, but about to announce a fully exclusive product that we've got through a bank that is going to be pretty good within the specialist finance marketplace. So keep an eye out for that. It's very much the people we employ, a minimum of 5 years specialist financial services experience. They won't even get through the door for an interview unless they've had 5 years in our industry, not 5 years behind the counter at Nationwide, 5 years doing what we do. So I'm quite lucky. We've got a few competitors around our area that are very good at the training side, and one especially is not very good at actually retaining those staff. Mature life experience is the biggest thing, really is the biggest thing. You do not want to be speaking to people. I took my son on Monday to Heathrow Airport. He's going traveling the Far East for 6 months with 3 friends from university, 3 girls from university in their early 20s. And believe me, you would not want them speaking to you about financial services if they were working. If it just there was absolutely no maturity whatsoever. All incredibly intelligent, but absolutely no common sense whatsoever. And it was quite scary. All 3 of them were exactly the same. On the rare occasion that something goes wrong, because they've got that maturity, they can recognise it early and have the experience to deal with it. That's why we don't get complaints. We really don't get complaints. Our last complaint was in 2020 because a lender was taking 7 weeks to respond to queries. And the client lost money on the deal, but of course made the complaint to us, just basically trying to ensure that he didn't have to pay any form of broker fee. And that was it. Didn't go any further. But we don't get complaints. And why are we different? Our lender relationships. I've grown up in the industry, started in 83. In 89, set up my first brokerage. A lot of the people that I dealt with at that stage that were BDMs are now in very, very senior positions with lenders because they're all in their sort of like 50s, 60s. And I've known them for years. I've classed them as friends. So it's that lender relationship side is absolutely key, and that's probably the majority of the lenders that we deal with. We've got that relationship at board level. How seriously we take compliance? Incredibly seriously. We've been told by the NACFB we are in the top 3% of brokers that they have registered with them. We've now just had our third compliance visit and passed with flying colours. It's how seriously we take the prevention of financial crime. Don't come across it very often, but when we do, we deal with it. We don't bother forcing the issue with the police anymore because it's a complete waste of time, because the courts just let them off with a suspended sentence. And it's not on numerous awards from the financial press. And I always say this: you'll never see me win an award at within any of the financial press meetings, because I would never accept it in the first place. I really wouldn't. I'm unlikely to get a lifetime achievement award because I've been too critical of the award system. It's purely there to make substantial amounts of money for the financial press. It's their biggest profit centre, and because of that, it's open to. With some of them, it's open to corruption. So a little bit about broker awards. This is one that we see on a fairly regular basis. This was back in, I should probably update this now, but 2021. Vote for me on Facebook. Vote for me, and you could win a £250 Amazon voucher. And that's his Facebook friends. And he won it. And he goes around saying, I'm the best broker because I've won all these awards. No, you're not. You've just got friends on Facebook, Twitter, and Instagram who vote for you when the awards come up. So it's a joke. So when you do see a broker, and when it comes to lenders, I can understand why lenders will receive awards, but let's face it, there's plenty of people that can vote for them. Who's voting for brokers? Is it lenders? Quite often, no, it's not. This is a recent awards. This is back in June. Main sponsor was HSBC. I'm not going to go too much on this, but I will just say I'm not alleging any wrongdoing has taken place in any way whatsoever. I'll let you make up your own mind. These were the winners. All of those companies, brokers and lenders combined, you can see all winners. And these were the sponsors and regular advertisers. Almost all of them. Make up your own mind on that. And this was the other thing that just want to point out from that. HSBC were the main sponsor, and also sponsored two categories, Best Network and Best Surveyor. And Central Trust sponsored the Best Second Charge Broker, and Central Trust are a first charge lender. And these were the winners. HSBC won these awards: Best Mortgage Lender, which is the top award at that particular event, and the Best Second Charge Broker was awarded to the Loans Engine, which is a subsidiary of Central Trust. Make up your own mind. What else do we offer? Designated underwriters from start to finish, except now we have an experienced person dealing with cases from pre-offer to completion. That experienced person is me. Because something I see far too often is solicitors getting an instruction and then thinking, oh, I can make a few quid out of this. Let's see if I can stretch it out as long as possible. We do not allow them to do so, because I will call solicitors out when I need to if I feel that they are stretching things out or are just not doing their job properly. We have systems in place now to ensure they do their job properly. And guess what? We're getting far quicker completions than we were this time a year ago. Far, far quicker. Commission paid immediately upon loan completion. No excuses, always paid, unless it turns out to be fraud. That's where the commission clawback is. If there's no commission clawbacks, unless it turns out to be fraud or the client cancels the contract within normally a 14-day period, then we would have to claw back commission, obviously. But the main thing, we do pay your commission on the day of loan completion. What else we can offer is that every deal that comes to us, once we got the client's permission, we will credit search. And by credit searching, it means that we find out on day one what we're dealing with. Not the client's version of what we're dealing with, or the client's search, which quite often does not have the information that we require. And also, the information between Equifax and Experian can vary massively because there's people involved. I know these are computerized systems, digital systems, but there's always people involved in this somewhere in the mix, and people make mistakes. So quite often we'll see stuff that will show up on Experian, it doesn't show up on Equifax. So of course, we'll go to lenders that use Equifax rather than Experian, because it might be something that is absolutely, the client doesn't even know about themselves. We obtain a soft credit search at our expense right from the outset. It means we're going down the right road from the start on every single occasion. And the only time we have problems is when the credit search is delayed because our broker partner or the client is saying, no, hold off from doing searches. And then when we do the search, we find out why they wanted to hold off. It's because they got half a dozen defaults they hadn't declared. So we always look to get it done as soon as possible, and it saves a hell of a lot of time, as you can imagine. And our business is sourced in-house. We are trying to find ways now to get these onto our website. It's quite tricky because of various things. But as you can imagine, at the moment, we update all these in-house ourselves, and most of them are updated by me. So I was up till just gone midnight last night updating some second charge lenders who made some changes yesterday. But all of these are updated on a regular basis, as regular as we possibly can do. A very, very difficult job. It means we can, if you phone us and speak to one of my staff, say, I had this second charge, these are the details, and we run it through the system, we can give you an indication straight away of what the likely costs are going to be from the lenders who have a rate card. And the same with the commercial side, which takes into consideration the client's overall portfolio calculations, the calculation on that particular property, if it's an investment property. Same on bridging. We can quote on bridging from a massive panel of lenders within seconds. Data security, very, very important. One of the things I've realized a long time ago was that my business could be wiped out by something happening that's completely out of my control. So our data is as secure as it gets. We've had IT penetration tests done now on our system. They can't get anywhere near the data. So it's something we take very, very seriously. So if you pass your clients over to us, that data is not going anywhere at all. Our second charge panel, literally everybody, just always make sure when I just scan this that no one's actually pulled from the second charge market. I probably need to remove one there because they pulled temporarily. But that's our second charge panel. Just if you are involved in second charges and are you using either the LNG or the Simply Biz panel, here's an idea of what you're up against, because of the lenders you'll see there, Marsthaven, Precise, Shawbrook and UTB, 2 of them are not lending in second charges. Precise pulled out earlier on this year and hadn't actually had a product for 2 years. Marsthaven pulled out, I believe it was in 2021 when they stopped lending altogether. That's still showing up as of, I'm trying to think when that was, I think it was around July time, July, August this year. So that's the LNG, and this is the Simply Biz, which is pretty similar. Got Marsthaven, they got Precise. They've also got Paragon, who haven't been in the second charge market now for 2 years. So all you've got left really is Shawbrook and UTB. No Optimum, no West One, no Selena. The lenders that are actually offering the best products at this moment in time don't even appear on those panels. So when you do have a second charge, I strongly urge you to pick up the phone. If you don't want to deal with us, then deal with somebody else, but actually deal with a company that gives you whole of market access. Because otherwise you're probably doing a disservice to your client. Our regulated first charge panel, the main ones we have on there is the Family Building Society. We're still waiting on the fixed rate products to come back, unfortunately, and Precise and Together. You see Central Trust and Norton there as well, which are mainly for the much smaller stuff, the mortgage-free properties where someone wants the capital raise 15, 20 grand. But we can give way. If you want to give the advice with those lenders, you certainly can do. Our specialist buy-to-let panel, pretty much everybody that you see there. And if you wish to give the advice, those lenders you see. So pretty much covers the whole of the market. There was a question actually earlier on that about flats under 30 square meters. For those of you that aren't aware, Quantum Mortgages have so far since they launched, the smallest flat they lent on was 11 square meters, and we have packager status. And I know not only know the board members very, very well, but an ex-member of my staff also works there and deals with us. So you can imagine that the service we get is second to none. So if you've got any cases that are under 30 square meters, give us a call. Also, on our buy-to-let, we have a 0% fee package panel. So for these lenders, if you pass a deal over to us, we don't charge a fee. We don't charge an upfront fee. We don't charge a completion fee. And the reason we do this is that because of the way we're set up, we're able to find out pretty much straight away whether a lender's going to accept it. So we're not wasting loads of time on a deal. And for that reason, there's no fees charged. And this is an idea, this is what we're up against. Now, this was taken from Mortgage Brain a few months ago. You see 3MC charging 95, all the way up to TBMC. TBMC charging 299 quid up front. That's not on completion, that's up front. So if you've got a deal and you want to put it through a packager, then for the lenders I already mentioned, your client's not going to be charged any fees. So that obstacle was immediately overcome. Our bridging lender panel, advised on an advised basis, and there's a large number of lenders there also offer regulated bridging. As you can see, all those are on our calculator, our quoting, our bridge quote system, and we can quote within seconds. Our commercial lending panel, all the lenders you see there, again, substantial number of lenders covering the whole of the market and every single scenario you can ever think of. Majority of quite a few of those we also offer on a package basis. Well, most of we offer on a package basis. We have brokers that give us business because they're no longer FCA authorised. So the likes of NatWest, for example, will not take business from, even though the lending's to a limited company on a commercial property. Work that one out. And the same with Barclays and Lloyds in many cases too. But that's what we have available on the commercial side. And if you wish to advise on second charges, Matthew's covered this obviously already. You do need access to every lender in the marketplace if you wish to advise. And you do need someone to help you with the sourcing, because you can't use the Trigoals, the Mortgage Brains, and the 27 Tech, because their products aren't fit for purpose, mainly because they're actually just there for one particular packager. So you're not really getting a fair idea of what's available, because of course they all incorporate their fees. Now, if you wish to advise on second charges, we do not charge a packager fee up front or on completion. You have the control. We do all the donkey work in the background. We'll source it for you, instruct the surveys, issue consent to, if the consent's required, to a second charge, do all the packaging as you would normally expect, pay you on the day of loan completion, no fees to the customer. A large number of brokers using this that want to get involved in second charges but don't really want their clients being charged £5,000. You can charge whatever you want. You want to charge 395 quid, you can do. I've got one guy who charges £5,000 in every single deal. Up to him, that's his business model. But you have the control. Not available for regulated first charge mortgages, so don't start giving us Halifax deals where you don't want us to charge a packager fee, because I don't really want to package Halifax deals anyway in the first place when somebody's got access to them, as you can imagine. But not available for regulated first charge mortgages. That's our second charge product. If you wish to know how much we'll pay you, just type PROC into the type your message box below, and we'll issue this. It's I think it's currently got, I think we're on blue dice rather than red. We've got two different colours, so we can tell which one it is. But we'll get that out to you today. Absolutely no problem at all. And that has a full list of every single lender that we deal with. Well, every lender we deal with that's on our main panel, our tier 1 panel. Of course, we do have a large number of lenders on our tier 2 panel as well. We don't have the likes of BM Solutions and Virgin Money on within this guide, because it'd be pointless. You've got access to them yourself. But there are some brokers out there who haven't got access to them. So we still deal with those lenders. So just type proxy. A few of you have already done that. That will come out to you today. Beware of the bandits out there as well. I mean, we're very upfront with what we pay, what we receive, and also what we pay. Just be really aware. I always used to quote one from a guy we met at one of our shows back in 2018. But then we found this one earlier on this year, where we was asked to step in and do the exit for the deal that was written. £7 million case for a titled applicants, and the broker, what is now our broker partner, was paid £7,000 by the master broker, and was told it was half the proc fee. The master broker earned £117,000. That's disgraceful. I'm so sorry. There's no other word for that. Absolutely disgraceful. But there are unfortunately people out there like that. I even have heard of some master brokers doctoring the PDF to saying how much they will earn, so they can get away with actually taking more. So just be very, very careful with who you're dealing with out there, because there are some absolute cowboys, unfortunately, still in the middle. I don't think Consumer Duty would do too much to get rid of them, but that's the way it is. A couple of case studies. I won't go through all these because we are a little bit short of time, but this was just one we did earlier on this year. Very, very difficult case because of the way it was originally set up. An ultimate beneficiary based in Panama. Very, very complicated for most lenders, but we managed to actually get this through with YBS, who are probably one of the strictest commercial lenders we deal with on what they will take. Introduced smart loan, £12,187.50p on the day of completion. Incredibly difficult case, but managed to get it through. This was another case study. Bridging finance completed in November 2021. 20-bed property, planning for 10-bed HMO, but the previous owners have been using it as a 20-bed HMO. One of the rooms, I think, was 7 square meters? It was a shoebox, but he was still renting them out, obviously legally. Loads of issues. Another issue was that neighbouring property had been stealing electricity supply for some years, and the guy probably couldn't work out why his electricity bill was so high, but he probably didn't care too much because he had 10 unlicensed bedrooms within it. We arranged a 10-month bridge, 2.15 million, no broker or packager fees. Introduced got 21 grand because, as with almost all of our lenders, we do have packager status. So therefore, we get more than you would if you went direct, and we will pay you the same as if you did go direct. And that's the way we find. And once someone starts using us, we tend to find they don't go anywhere else. Another case study. This was one that we completed. The most difficult case I've ever dealt with. And I had to step in on this one on the solicitor side because I came across the worst solicitor that I've ever had to deal with in over 30 years of broking. He was an absolute cowboy. There were 5 properties that had charges that hadn't been removed by him dating back to 2002. He'd just been basically milking these clients for fees for many years and not doing the work. So it was horrendous. And if you've ever tried to contact one of these South London councils to try and get a charging order removed that was registered in 2003, you'll realise how difficult it actually was. But it was horrendous, really horrendous. But got it through, introduced a partner, 45 grand he earned, and he gave us a name and telephone number. And that's all he gave us. But it's an awful case, but happy clients because they were about to lose the entire portfolio because they couldn't find anyone that was prepared to do it until we came along. And this is what he said. I won't cover the whole thing. This was put on Trustpilot. Trustpilot have unfortunately taken it down because they thought it wasn't genuine, but believe me, it was. If I give more than 5 stars, I would. I won't give the whole thing there because if you do want to look on Trustpilot, it should be back up fairly soon. But this particular broker partner is now giving us business like you wouldn't believe. And he's semi-retired. He's earning more money semi-retired than he was when he was a fully active mortgage advisor. Just gives you an idea of, and he said to me, I wish I found you years ago because I would be fully retired by now because I wouldn't have needed to carry on. But one very, very happy introducer. And the last case, I'm hoping it's the last case study, that Lord and Lady I mentioned, this is the one that we did, 18 properties, all in the same village. You'll probably be thinking that'd be pretty tough with any lender on the concentration issue because lenders don't like that. Too many properties concentrated in one area. Came to us in the middle of COVID. As you can imagine, quite difficult to lend to what was an 85-year-old and 81-year-old during COVID. Trying to get that across to the clients was quite difficult because they were a Lord and Lady. Second most difficult case I've ever dealt with. I introduced a partner around 30 grand on the day of completion. Didn't charge any fees. It's just basically what we got paid by the lender. We halved it because we didn't want to be seen to ripping them off unlike the previous master broker. And it's not what you know, it really is who you know in some cases. Again, most of you, a lot of you would have heard this from me before, but I'll probably be still dining out on this to the day I die, I should imagine. Husband and wife business. Mr. was a crook, defrauded HMRC of £850,000. Airline pilot, but spent quite a good share of it was on cocaine, which is always very worrying, and other illegal activities. She divorced him. He went to prison for 5 years, and unfortunately, every jointly owned asset had a Proceeds of Crime Act charge. As soon as you approach a lender with a Proceeds of Crime Act charge issue, it's all can't touch that reputational risk. Literally everybody. They just will not touch them at all because they can't see the bigger picture sometimes. That's underwriting departments and compliance departments. Compliance departments are the biggest problem we got, by the way, in this type of situation. This is what we did. Came to me to sign off as a decline. I thought, I'm not declining this. There must be a deal here. So I made a phone call to a director at Together that I've known for many, many years. Would consider a good friend of mine. Gave him no view of the case. He said, well, I really want to do that deal. Why aren't we doing it? Well, your compliance department said no. Give me 10 minutes. He came back 10 minutes later. We'll do it. And that had been turned down for numerous other brokers. His compliance department basically, when he went to them, slightly different to an underwriter going to them, where they can say, well, we're more powerful than you, we're declining that. Director approaches them. Yeah, actually, maybe we should be doing that after all. 12 grand, just under 12 grand, the introducer got on the day of completion. He did write us a very lovely testimonial, but I'm not actually showing that today. But again, it's not what you know, it's who you know, because that deal was going nowhere. She would have lost everything. Business, home, the lot. The lot would have gone. And we managed to save it. And I spoke to her about 3 weeks ago, and she's still thankful for what we did. Still thankful. Cases you can't place, obviously various ways of giving it to us. If you got anything, type in the message below. Decision in principle form we sent you this afternoon. Might already have been sent to you, actually. There's one for every product. Just complete one of those. Go on the website, complete it online if you want to, or just pick up the phone, give us a call, and we can deal with it straight away. Staff are ready to take your call. You should, if you're on LinkedIn and we've been able to find you, you and I are not already linked, you will receive a request. So please accept that request from me. If we can't find you because your name's John Smith and there's about 200,000 of you on LinkedIn, it shouldn't be too difficult to find me. So please send a request to me and I will gladly accept it. But you should actually have that. I've seen there's been a few actually over the last couple of days. But anyone that signed up in the last 48 hours, we probably haven't sent a request to yet. If you like what you've seen today, when we send you out our introducer pack or broker pack, you'll have an agency application. don't need this to actually take a deal from you, but I do need it to pay you your commission when the case completes. So just make sure if you do want to get into this partnership with us, that you get that back to us as quickly as possible. Next year's specialist mortgage web shows, we do have the dates. Unfortunately, when I was doing this late last night, I didn't have access to the dates, but it's every month, normally the first Thursday of every month, except July, because it's my 30th wedding anniversary on that day, and I'm also celebrating my 60th birthday. So my wife's taking me away somewhere. So not that one. I think it's the second week of July next year, but we're still going to continue in the same format. We're going to make a few tweaks in the new year. Got discussions this afternoon with my marketing and IT team what we're going to tweak from now on. Feedback and CPD, feedback, not feedback. Feedback and CPD. When you leave today's session, click the event board in the top right corner, and then the red exit event box. Then automatically the feedback will pop up. Complete that for us. Very, very important. We need to know what you thought of today's speakers. Please don't mention the 5-minute outage that we had earlier on, which was because of the internet signal, because it was raining outside. And your CPD certificate will be emailed to you shortly afterwards. If you haven't got it by the end of the day, check your spam, because probably of the 10% of people who don't get their CPD, 90% of them is in their spam folder. So just check that, then give us a call if for some reason it hasn't turned up. There is one of you that actually has given us an email address that the mailbox is full. So just check that you've not got any issues with your mailbox as well, because we do quite sometimes find that if you've got a full mailbox, you won't receive anything. Okay, please help us out. If you can leave us a review on either Trustpilot or Google. You see there, just search Google Review Specialist Hub or Trustpilot Specialist Hub. Don't go to Specialists Hub with an S on the end, because that's a completely different firm, I believe might have gone bust now. Nothing to do with us. But if you can leave us a review, that would be much appreciated. And hopefully if it's on Trustpilot, they won't decide that it's a fake review and cause us a load of grief. Thank you to today's sponsor again, MFS, for their help and they're basically promoting today's event. It's been absolutely fantastic, and probably one of the reasons why today's event has been the largest number of delegates we've ever had sign up, and I believe the second best in terms of numbers of delegates that have actually attended. Hopefully I didn't lose too many when we went down for 5 minutes earlier on this morning. And I think with that, enjoy the rest of your day. And I actually realize it says until next month. We're not having 1 December. Until next year, stay safe, stay sane if you can, and hopefully keep prosperous. And I'll hopefully speak to you again soon. Thank you.